I've been involved in the markets now for about 6 years, but specifically trading futures for almost 4 years now. And honestly, my early years trying to trade futures was brutal. I blew through hundreds of evaluations and challenges before I ever got my first payout, and I dug myself into a pretty deep hole buying challenge after challenge after challenge, not really understanding what I was doing. But it's not because I didn't care, or it's not because I wasn't studying or I wasn't putting in the hours. I was obsessed with trading. It's the only thing I would think about. But I was constantly being distracted by noise. New indicators, new strategies, new concepts, new gurus, new signal rooms, new systems. And I was chasing certainty in a market that doesn't actually provide certainty. And like most traders, I thought the answer was just finding that right setup, or finding the one setup that has this amazing win rate and I'll just do it every single day. And I thought if I could find the perfect strategy, that everything would finally just like click. But eventually, what I realized was that the problem wasn't that I lacked setups. The problem was that I fundamentally misunderstood what the market actually was. Because the market is not just a collection of candlestick patterns. It's not random movement, and it's not an indicator game. The market is an auction. It is a live negotiation every day between buyers and sellers. Price moves because liquidity is being accessed, because participants are becoming aggressive, because large players need counterparties to execute size. And once I started to understand the mechanics behind the auction, everything changed in my trading. I stopped obsessing over predicting every move or trying to force trades in dead environments, and I stopped reacting emotionally to every single candle. And I just started focusing on what actually matters. Context, liquidity, participation, acceptance, imbalance, and most importantly, execution quality. And that is when I finally started finding consistency. And it didn't happen overnight, and it did not happen instantly. But slowly, things started changing. My process became cleaner, my execution improved, and I tightened the back end, and I stopped taking random C-game trades. I stopped forcing action every single session, and I built an actual system around how I operated. And eventually that led to consistency in my trading, consistent payouts, 20K months, 30K months, or just 5 figures in payouts consistently. But honestly, the biggest shift wasn't even the money. It was understanding why the market actually moved in the first place. Most retail traders completely misunderstand markets. They might think that support and resistance alone is what moves price, or indicators alone is what moves price, or they think in terms of candlestick patterns, or that aggression alone automatically means direction. But aggression alone doesn't actually move price. Acceptance is what moves price. You can have aggressive buyers slam the ask at highs and price can still collapse. And you can have aggressive sellers hitting the bids into lows and price immediately reverses. And something to note is that order flow alone is not an edge. It's also not even a strategy. Order flow is just data. That's all it is. But the edge comes from understanding what that data means within context. And that's really what auction resolution became for me. Not necessarily a signal service or some type of holy grail setup, but it's a framework for understanding when the market is balanced, imbalanced, when participation actually matters, and when conditions are statistically worth participating in. Most traders will actually lose money because they are forcing trades in an environment where their edge or no real edge exists. They trade chop, they trade low volume or low volatility. They might take trades randomly in the middle of a range, or they're reacting to price emotionally rather than structurally. And yes, you do need an edge, but a lot of traders don't even fail because of their edge or their strategy. They fail because they can't survive themselves. Because you can have an edge, but if you don't properly execute the edge, then the edge is useless. That's where you're over trading or revenge trading or breaking risk rules or even forcing action just because you're bored. Or even just trying to come into every single day and force making money every session or every time you get on the charts. And I know that because I lived it. I did it for years and I lost money doing that constantly. And that's why the framework that I have now is not just about entries or setups. It's about survivability. Because if you cannot survive variance, then nothing else matters. So throughout this video, I'm going to break down how I actually think about the markets, how I build context, how I map liquidity, how I identify imbalance, how I use footprint and order flow for confirmation, or think about volatility or sessions, and how I avoid low quality environments. And I'm going to tell you how I structure decisions under live pressure. This is not about predicting every move that the market's going to make. It's about learning how to think structurally rather than emotionally. Because once you understand the auction underneath price, you stop reacting to noise and you start understanding why the market is actually moving in the first place. So I'm going to go over the idea of how it is that I look at the market. Now, just before we get started, the way that I trade is basically using auction market theory, and I'm using order flow, and I have some things that I use that's slightly different than your typical auction market theory trading or order flow trading. Now, just to make it kind of clear, what exactly am I trading? Well, I'm trading typically NASDAQ futures or gold futures. And the platforms that I'm using is ATAS for order flow analysis, Deep Charts for order flow analysis and execution. And then I'm using TradingView for when I'm charting. And I'm looking at Tanuki Trade for gamma exposure or GEX analysis. Now, the framework that I use is very similar to every other order flow trader out there, where you're typically looking at environment and context, and then you're trying to identify location, and then you're considering the path to location, and you're using order flow for confirmation. When it comes to environment and context, the basic idea for auction market theory is that we are constantly cycling from balance to imbalance, to balance to imbalance, to balance to imbalance. And I'm paying attention to where the market state or where the market is balanced or when it's imbalanced. And I'm also looking at very basic market structure. Is the market going up? Is the market going sideways? Is the market going down? It's real basic market structure. I'm literally looking at higher highs, higher lows, lower highs, lower lows, and I'm looking at it on a 4-hour, a 1-hour, a 15-minute, and a 5-minute structure. In terms of additional environment or context, I'm paying attention to what it looks like in terms of gamma. Are we sitting in a positive gamma environment? Are we sitting in a negative gamma environment? Are we sitting right in between the gamma flip level, or where are we in relation to major levels on a gamma map or a gamma profile? So the process is pretty basic. I'm understanding market state. Are we currently balanced or are we imbalanced? Are we bullish, bearish, or are we consolidating sideways? And then are we sitting in a positive gamma environment, a negative gamma environment, or are we somewhere in the middle around the gamma flip level, or what Tanuki Trades categorizes as or labels as the HVO. And I'm understanding in terms of the bigger picture where we're at and what are we doing. And that's just the very basics of understanding the environment and understanding context. Now, the thing that I look for next is I'm looking for location. So how do I actually determine location? Well, typically what I'm doing is I'm taking a range where we have an established swing low and swing high, and I'm marking out a volume profile. Now, when I'm doing a fixed volume profile, I'm just marking out from where the swing low was to basically where the swing high was and the price action that's happening in between it. Now, the idea for me is that I am only considering to buy and discount when we're bullish. I'm looking to sell in premium when we're bearish. And the way that I view discount and premium is I'm looking at it in relation to the active range and where value area is typically sitting. So in this example here, if we take this swing low, this swing high, and we are marking out the value area for this location, we have value area sitting here, POC sitting here, you have value area high, value area low, and the POC. Now, what I typically do is I will draw from the same swing points that are establishing this range is I'm going to draw a Fibonacci retracement tool. Now, I know people have a lot to say about Fibonacci retracement tools. You know, it is what it is. I use them. They work for me. So this is part of my framework. So what I'm looking at is I have levels on my Fibonacci retracement. That is the 0.705, the 0.788, and the 0.886. And what I'm looking for is I'm using this area for discount that is below value area. So if we are bullish, then anything below value area, I'm looking for basically a failed auction lower into discount for us to then continue the trend to the upside if we're bullish. And vice versa would go for if we're bearish. So if we were in a downwards environment or we're trending to the downside and I draw out a fixed range profile, let's say, and it has value area sitting here and here, and if I were to draw my fib and it creates my levels sitting here, then I'm waiting for price to try and break out a value area high to then fail in my zone with the fibs, and then I'm looking for us to continue that momentum to the downside. I'm using the fibs in relation to value area to look for a location where I would like to enter into a trade. But just because we enter into this location doesn't mean that I'm automatically going to take a trade. It's just a location reference for me. Something else that I'm looking at when it comes to location is I'm looking at gamma exposure or gamma levels. And specifically, I'm looking at not only the environment, but also the levels themselves. I'm looking at the call wall, the gamma flip level or HVL, and the put wall. So let's say we're looking at the call wall. I am watching the call wall, and when price is approaching it, I'm paying attention to footprint to understand if we are going to accept above this level or if we are going to reject. And of course, in terms of location, I'm understanding where resting liquidity is actually clustering. Resting liquidity and how it's actually being visualized to me is I'm looking at it on a heat map, or I'm looking at it on the DOM expressed as levels. One thing to note is that resting liquidity is going to be resting limit orders. Stop orders are not going to show up on your heat map because they are held server side. So when they actually do get executed, they get executed as market orders. So these are limit orders that we're seeing on here. And also, this visualization of liquidity is not all of the liquidity, because you also have iceberg orders, you have dark pools, and you have things that aren't going to be represented on this heat map at a first glance, or that we're going to be able to see on here. But I do want to understand where that resting liquidity is actually clustering. Typically, we may see it cluster around psychological levels, such as round numbers, or we may see it cluster around highs or lows. And also, there's resting liquidity that just sits within the book all throughout the chart. Now, once I determine location, we understand the environment. We understand if we're balanced or imbalanced. We understand if we're going up, sideways, or down. And we understand the volatility environment or the gamma exposure environment that we're in. And we're trying to identify location. We want to buy in discount. We want to sell in premium. I'm using fixed range volume profiles with fib retracements. I'm looking at gamma levels, and I'm understanding where resting liquidity is clustering. Once I understand potentially where I'm looking to take a trade, I do need to take into account path. Now, what do I mean by path? What I mean by path is how a daily candle itself is actually going to form over the 3 sessions. Now, I understand there's more sessions, you can break it down, but the way that I look at it is I typically will look at it in terms of Asia session, London session, and then New York session. I'll go further into sessions a little later on, but the idea is I'm trying to understand how the daily candle is actually going to play out. In the event that we have a daily candle, well, typically a daily candle will open, a wick might get made on either side before we actually go and resolve the true direction of the market or where the day's actually trying to go. And what I'm also doing is I'm using an indicator that I created that was based off of historical data with specifically NQ. That's just telling me on average how far are we deviating above Asia high and Asia low. And the purpose of it is basically to look at this in terms of one big daily candle. So here we have the daily candle essentially opening or very close to where it opens. Price then goes to form the wick to the upside before we end up coming all the way down. So I'm using sessions and I'm understanding Asia session, London session, and I'm paying attention to how the overnight formed in relation to the rest of the context, the rest of the environment and location to understand how might New York play out for the AM session, because I'm typically only trading the AM session or the first hour and 30 minutes of market open anyways. Now, once we actually understand path and we understood location and we understand environment and context, the last thing left, if we already know what we're expecting to happen, then we're just looking for confirmation. And when I'm looking at a footprint chart, this is where I'm looking for my confirmation. So on my footprint charts, I'm going to have the bid and the ask in a footprint candle. So it's the bid by ask footprint candle. I have a volume profile inside of it. I'm trying to see where participation is building. And I'm looking at all of this in terms of effort versus result in location that aligns with the bias and the context. And I'm using things such as big trades, or I'm looking at delta and volume, and I'm looking at participation and the outcome of that participation. If I see sellers positioning themselves in an area and we're coming back to retest that area, are sellers going to defend, or are we going to push back through it? And so I'm using order flow as my confirmation layer to actually enter the trades. So once we have that, then we have our environment and context. We're seeing if we're balanced, imbalanced, and we're watching a cycle in between the two of them. I'm looking at if we're bullish, bearish, or consolidating. I'm understanding the environment in terms of gamma that we're in. I'm looking for location in terms of value area and these fib levels. And I'm looking at gamma levels as well as where the resting liquidity is actually clustering. I'm understanding the path of the day for what a daily candle might actually end up doing for the session, at least during New York session. And I'm using what the overnight did to form a better idea on what I think New York session is going to do. Now, once we have all of that, now I'm dropping down to my footprint charts and I'm looking for confirmation, or I'm looking at effort versus result in location to play out what I was already anticipating for the morning. Now that we have a basic idea of that, I know I went over that relatively quickly and there's a lot of gaps that need to be filled in terms of information. Let's go a little deeper into all four of these parts of my framework: environment and context, location, path, and confirmation. Now let's take a quick break to tell you about the sponsor of this video, Prop Firm Match. Prop Firm Match has built-in comparison tools so you can compare prop firms against each other or even challenges against each other, and you have all the rules clearly laid out. You can even see which firms are actually being used by traders just like yourself by reading some of the reviews, so you know exactly what you're spending your money on before you buy anything. It makes it really easy because you have everything now all in the same place, and if you want to use Prop Firm Match, you can check the link in the description or in the pinned comment, and to make sure that you're getting the best deal on any of these firms, make sure you check out their exclusive offers and use code MATCH. Now let's get back into the video. Let me show you something that has probably happened to you before. Right here we have a very clear resistance level. Price pushes into it once, comes back to retest it. This is what traders would call a double top. Now, when a trader, especially maybe a breakout trader, might see this type of setup, the explanation is pretty simple. The idea would be that if price comes up and breaks this level, the market should move higher, and it should probably take out at least this high. I mean, that's what breakout traders are probably thinking. So they're sitting here waiting exactly for that to happen. Now, as price moves up, we get the break. We start breaking past the level. Now, at this point, breakout traders may be entering into this trade to have a continuation for us to push higher, to at least take these highs and maybe continue momentum further up. The pattern looks clean. The breakout looks legitimate. We're picking up some speed, it looks like. But instead of continuation, the breakout fails. We never take the highs, we never continue higher, and price essentially immediately reverses. And suddenly, all of those traders who try to enter in on the breakout right here are trapped. So I guess the question would be, if the pattern was correct, and if the breakout was real, why did it fail? Because patterns don't move markets. Participation does. And this is the mistake that a lot of traders make when they're learning how to trade. They treat patterns like they cause price to move, but patterns are just shapes, and they're just descriptions of what price already did. They don't tell you who's actually participating in the market. And to understand that, we need to talk about how markets actually function. So before we go any further, we need to understand something that's fundamental. The market isn't just a chart. It's not just candlesticks on a canvas. It is an auction. And if you don't understand how auctions work, it's very easy to misinterpret what you're seeing on the chart. So a lot of traders approach trading with the idea of basically pattern preference trading, or trading patterns that they see, whether that might be double tops, head and shoulders, trend lines, whatever it might be. Now, Most traders think that patterns move markets. They don't. Participation moves markets. And so almost every trader, they start the same way, right? Breakouts, support flips, head and shoulders, trend lines, and you start applying them. You learn these patterns and you try to apply them in your trading. And the logic feels solid and the chart seems to confirm it when you go back and you back test it maybe, and you find a setup that might check every single box, and you take the trade and it still fails. So you find another one, same result. The pattern looked right, the entry looked clean, but the trade didn't actually work. So this isn't necessarily like a discipline problem or a timing issue. This is a structural problem with how the trade was actually built. The setup is based on a shape on a screen, not on what was actually happening inside the market at that moment. And that gap between what the chart shows you and what is actually driving prices is where most trading accounts quietly bleed out. And so the question worth sitting with is simple. If the pattern was correct and we trade patterns, why did the trade fail? The answer changes how you think about every chart you look at from this point forward. So the idea is this, right? Pattern trading feels like it should work. It makes sense, it's intuitive. That's exactly why it's so hard to see the flaw. Now, the standard path in trading and what most videos online are going to show you or try and tell you is that people are looking for pattern recognition. Head and shoulders, breakouts, things like that, fair value gaps, trend lines, all of those. Now, these are tools that every new trader actually learns first. It's like the first videos that you'll find if you go on YouTube and you start looking up trading. And the logic behind them makes sense. It feels airtight because when the pattern appears, then the idea or the assumption is that price should follow. It makes sense, and that's what makes it so convincing. Now, this creates something called pattern preference trading. The trader is going to trust the pattern, and they're going to assume that the market is going to respect it. But the market has no awareness of this pattern. The pattern is a description of what already happened on the chart. It's not a mechanism that actually is going to cause price to move. The gap between how logical it feels and how the market actually works is where most losses might come from. So if the pattern appears, price should move. Well, that's the assumption that most retail traders take, and it causes losses. And it's wrong at a structural level. It's not about patterns. A lot of traders will follow this exact belief model. A pattern appears on the chart. They assume that it means the pattern is going to predict a direction and that price should follow that. But we're missing actual market participation. And that's the missing element. It's the only element that actually determines price direction. Because without it, the pattern is just going to be a shape on a screen. Now, we have to think about this in terms of cause and effect. The problem isn't that patterns exist. They exist. The problem is that traders believe patterns cause price movement. A breakout pattern does not cause price to move. Buying causes the breakout. This reversal is not a subtle distinction. It changes how you read every chart, every setup, and every failure. And the mistake is confusing description with causation. So when traders interpret patterns as a signal of what the market's going to do, they're going to treat it as an effect as if it were a cause. The chart tells you what happened, but it has no predictive power on its own though. Now look at two examples here, okay? Now look at how the same price movement is explained under each of these models. We have what most traders believe. A breakout pattern appears, pattern causes buying, and price rises. Now what's actually happening is aggressive buyers are lifting offers, available liquidity is being consumed, and price rises. The pattern appears after the buying, not before it. And trading the pattern as the signal is meaning that you're reacting to an effect and calling it a cause. So what actually moves the markets then? Because if patterns don't move price, then what does? Well, markets are moving when participants are transacting aggressively. That's it. It's not when a pattern is going to complete. It's not when a level is being touched. Price changes direction when one side of the market, either buyers or sellers, is willing to cross the spread and take the liquidity with enough urgency to overwhelm the other side. And understanding that single idea is the foundation for everything that follows. The market is not a chart necessarily. It is an auction. And once you start reading it that way, the entire picture is going to change. So the idea of markets being an auction, it is a continuous two-sided auction between buyers and sellers. So every tick is a negotiation on price. Buyers and sellers compete to transact, and price moves in the direction of whoever is willing to be more aggressive. There are two distinct types of participants in this process. So if we look at the diagram below that shows these two roles, we're going to understand the difference between them, and understanding it is essential. So the first type of participant is going to be an initiative trader. This is someone who moves price. They need to transact, meaning that they are going to lift offers to buy and they're going to hit bids to sell. And they're willing to accept worse prices to get filled, and their urgency is the market moving. Now, the other type of trader that we have are responsive traders. These are the types of traders that are providing liquidity at price extremes. So they're selling into buying, they're buying into selling, and they're fading price when it's moved too far. Their presence stops or reverses moves. And price movement is determined entirely by which side overwhelms the other. And no pattern is going to decide this. Only actual orders in the market decide this. So initiative buyers are the people creating the move. Responsive sellers are the people absorbing it. And every trade you take, you need to know which side you're aligned with and whether that side is winning. And the way that we think about this, or we should be thinking about this, is effort versus result. Aggression alone doesn't necessarily move markets. Unabsorbed aggression does. And this is the moment where most traders misread the market. You might see heavy volume and assume the move is real, but the heavy buying does not guarantee that price is going to go up. What matters is whether buying is being absorbed by something on the other side. Now, the two scenarios that I'm about to show below are going to look identical on a standard chart, and only the relationship between the effort and the result reveals what's actually happening. In scenario A, where we have buyers in control, okay, we have heavy buying pressure that enters. The offers are being lifted consistently and prices advancing with each trade, so that effort or that aggression is being rewarded with price movement. In scenario B, there is an absorption warning. We have heavy buying pressure that enters the market. We have large volume prints and prices barely moving. It's stalling, or it's getting ready to rotate potentially. Now that means that something on the other side is absorbing, and a reversal could be likely. Now it's not guaranteed, because just because absorption is happening doesn't necessarily mean that a reversal is going to follow, but it is something that we need to think about. Now, when heavy buying fails to move price, it's informative and we need to take note of it, because something large is on the other side of every single one of those trades. The buyers are pressing in and they're getting trapped. They're running their head essentially into a wall. Now, this is exactly the difference between reading effort and reading result. On a normal candlestick chart, both scenarios can produce an identical looking candle, and only order flow tools are going to reveal which one actually happened. Now, where does order flow actually fit into this? Candlesticks, they're going to show us what happened, but order flow is going to show how it happened and who is actually behind it. In candlestick charts, they show the outcomes of the trades, but they hide the process that created it, and that process is incredibly important, because you can see a green candle, but was that buying actually aggressive? Was it distributed? Did it move price cleanly? Did it stall? And order flow tools are going to open that up so that we can see what's going on. And we notice how much information is absent from a standard chart compared to what order flow reveals at that same price level. So if we were to take an example where we compare a normal candlestick chart to a footprint or order flow chart, on a normal candlestick chart, we all know what they look like. They have open, high, low, close. It's the result of the period. There's no participation data, there's no absorption signals. It's just showing the scoreboard essentially between buyers and sellers. On a footprint candle or an order flow chart, we see the bid and ask volume at every price level. There's tick by tick transaction data, and there's delta, which is aggressive buyer versus seller volume, stacked imbalances, absorption clusters, and we see the game that's actually being played. The core question is aggression being rewarded with price movement? If yes, follow it. If no, the opposing side is absorbing it, and that falls back to that thing that we said earlier about effort versus result. And location matters, okay? Because patterns and levels, they're not useless. They just don't do what you think they do. Location is incredibly important when it comes to trading, because it's going to tell you where something might happen. So order flow essentially is telling us if it's actually happening. You need both. I don't just only use order flow. I don't really believe that either alone is sufficient. but we use location context as tools. So you can still use things like support and resistance or VWAP or higher time frame levels or any of these other things that you may use to build context around a trade. And the sequence below is going to show how location and confirmation work together to produce a valid trade context. The first step in this, when we are approaching the markets, is we need to identify location. Now, this can be whatever you want to use for location. Prior highs, prior lows, resistance zones, supply, demand areas, whatever, okay? The next thing that we do is once price actually enters into that location, we start observing order flow. Are buyers lifting into that level? Is absorption forming? What's happening? And then once the participation is actually confirmed and that initiative activity is showing up and aggression is being rewarded, then we have valid trade context, because now we have location plus confirmed participation that's going to equal or give us a reason to actually engage with the market. And location without participation is not a trade. The level exists, we're watching it, but if no one shows up to act on it, then there's nothing to trade against. Now, understanding this should change the way that you might see the market, because when the mental model is right, you stop asking broken questions. The questions a trader asks reveals the model they're running. A pattern-based thinking generates questions that can't be answered by like observing the market. But auction-based thinking generates questions that are directly observable in real time. If we were to look at this below, what are some pattern-based questions? Well, those are things like, is this pattern bullish? Should this breakout hold? Why did my setup fail? Which pattern is most reliable? Is this support strong enough? Now, if we think about this in the terms of auction-based questions, we're thinking about it more so in the sense of who is being aggressive right now? Is that aggression moving price? Is the effort giving the result that we are looking for essentially? And is liquidity absorbing that pressure? Is initiative or responsive activity winning in this scenario? And these are not necessarily philosophical questions. They are observable in real time with the right tools. And so that is what makes this framework operational rather than theoretical. The market didn't fail your pattern didn't describe the market. And so if we come to the realization that patterns are not the answer, then what should the process actually look like? If we look at this side-by-side comparison of a retail model and an auction-based approach, it's the same chart, but it's an entirely different process. Now, a retail model, we might be sitting here looking at the charts and we're waiting for a pattern. We see the pattern, we enter the trade. On an auction-based approach, we're reading market context, we're identifying location first, and once price reaches that location, we're observing the participation. And then we're only going to execute if all layers align. So what are we doing? We're identifying market context, right? What kind of auction is happening? Are we in a range? Is price in balance? Is it directional? Is it imbalance or balance? We're identifying important locations, key levels, value areas, previous highs or lows, premium or discount, or whatever else you define as an important location. Once we're observing that participation, we're looking for confirmation. Who is aggressive at this level? Is that aggression actually moving price? And is absorption forming or not? And once we identify all three prior layers, we can execute based on confirmed activity. Now, context alone is not enough, and location alone is not enough. We do need confirmation. So the retail model or pattern preference trading basically skips the first three steps like entirely, and that's not a minor inefficiency. It means entering trades without understanding what kind of auction is actually occurring, or without knowing where resolution is likely, and without any confirmation that participation is actually present. So the edge in this framework isn't a pattern, it's the sequence. And the biggest change isn't just like opening up an order flow chart or using the right tools, it's just the perspective of it. Everything above comes down to one transition in thinking. You stop looking at charts as collections of patterns and trying to pattern preference trade, and you start reading them as records of auction activity. And patterns become descriptions, but participation is what's going to be the actual signal. The question changes from what does this shape predict to who is transacting here and are they winning? And that shift is the shift that we need to have. Patterns to auctions. And once it happens, the way you read every chart or every level and every trade changes permanently. So the summary of this and what this means for how you trade is essentially this. Patterns describe structure, not cause. and they appear after the participation, not before it. They are effects, not signals. Markets are continuous two-sided auctions. They move based on which side, initiative or responsive, is more aggressive. And aggression must be unabsorbed essentially to move price. And we have to think effort versus result. Is the move being rewarded? Is that effort being rewarded with price movement? If not, somebody is absorbing it. And order flow or order flow charts are going to reveal the process, not just the result. Who is aggressive, where's liquidity sitting, and whether that aggression is actually working. And the layer of the framework goes context, location, participation, and then trade. Every layer of that framework must confirm before you engage. And that is the sequence of the edge. And if you want to understand markets at a deeper level, you have to stop thinking about charts as patterns. You need to start thinking about them as auctions. So the next time that you see something like this, don't just ask whether this pattern is clean or not, this double top is clean or not. We need to ask a different question. Who is actually participating in the market right now? Because markets don't move because a pattern appeared on a chart. They move when traders are willing to transact at worse prices. And when that participation isn't there, even the cleanest setup in the world can fail. So what you're really trying to learn as a trader is not necessarily patterns, but it's the auction and how it actually moves. Is price being accepted above these highs? Are we going to continue higher? Or is the move essentially getting absorbed? And that difference separates guessing between actually reading the market. So in this video, I'm going to break down what order flow actually is when we're looking at charts like this, where we can see what's happening inside the candles, and why it matters, and why relying on candlesticks alone is one of the biggest limitations that most traders never fix. So if you've been trading for any amount of time, you probably already know support and resistance, patterns, breakouts, trend lines, and yet you might still be inconsistent. Now you might catch good trades sometimes, but under pressure, things fall apart. And it's really important to know as a trader on what's actually moving price. Most traders are making decisions based on the appearance of price and not the mechanics that are actually pushing it behind the scenes, behind the candlesticks themselves. And that is the gap. So at the core of order flow or auction mechanics, we're viewing the market as an auction. And now every single tick is a transaction on a chart. It's a transaction between buyers and sellers. And there are two types of participants in this market. There are aggressive participants and then there are passive participants. Aggressive traders use market orders. So this is where you're entering, clicking buy market or sell market, and you're getting filled at the next available price. When you're doing this, you're crossing the spread and you're forcing trades to happen immediately. Now, passive traders are traders who are using limit orders. They sit in the book or they sit at certain levels, they place a limit order or a stop order, and they're waiting to actually get filled. Now, price is only going to move when aggressive orders enter the market and overwhelm the available resting liquidity on the other side. That's it. The market does not move by passive orders. Someone needs to be there to take the initiative to cross the spread to attempt to move price. And that is the entire engine behind price movement. Now, here's the problem. Candlesticks alone don't show any of that. What they show you is they show you four things. They show you the open, the close, the high, and the low of a single candle. That's it. But what they don't show you inside of this candle is they don't show you who was aggressive, where size actually came in this candle, and whether buyers actually succeeded or whether they got absorbed or trapped. A bullish candle doesn't necessarily mean that buyers are in control. It means price closed higher, and there's a difference to that. Because like let's say in this candle, you can have aggressive buying, or there was aggressive buying at the extremes of this candle, we can make an assumption, but price couldn't continue higher. And if you can't see what's happening in real time, you're reacting to something that's already finished. Now, order flow is the layer that shows you what's happening underneath the candle instead of just seeing the result, right? You're seeing the interaction between the buyers and the sellers. So inside of every footprint candle, we can see the bid and the ask, the volume at the bid and the ask. We can see delta. We can see where trades were actually executed and where participation showed up. Now, instead of just guessing what happened inside of this candle, we can actually see it. we can see where buyers were aggressive, where sellers stepped in, where price potentially stalled, or where it accelerated, right? And when we use order flow, all order flow is just data, okay? We're not using order flow necessarily to predict the market. It's just about reading what's happening in real time. And the most important thing about order flow and the way that I use order flow is a single concept. And this concept really changes everything. And it's the concept of effort versus result. Just because there is aggressive buying, right, it doesn't mean that price has to go up or that price will go up. And just because there is aggressive selling doesn't mean that price is going to go down or has to go down. What matters is how the market responds to that effort that we're seeing on order flow, on footprint candles. Because if buyers are aggressive, let's say in this candle that I showed you on the normal candlestick chart, if buyers are aggressive here and price isn't successfully moving higher, well, then that is information. This is potentially absorption. And if we were to go down here and take a look, if we see sellers being aggressive or aggressive selling in this area, in this entire area, we see sellers trying to be aggressive and push price lower, and price isn't actually moving lower or they're not being successful with their effort, then it's essentially the same thing. Now, on the flip side, if we were to go look at a move, right, and we see that effort is moving price significantly, that can tell us that there's little to no resistance by the other side or the other party or sellers in this case. And this creates imbalance. And you can see the stacked imbalances of buyers over sellers inside of the candles with these bold numbers that I have on my chart. But there's other ways that you can view it depending on how you set up your footprint chart. But this is the difference between reading the market and just reacting to it. Now, this is important because this is where most people actually get it wrong. Order flow itself is not the strategy, okay? It does not give you trades necessarily by itself just because you have more data. The way that I use it is I use it as a confirmation layer. And I still need context, location, and structure. Order flow is just telling me, is what I'm expecting actually happening right now? And it confirms whether the market is accepting or rejecting a level. And without that, you're essentially just guessing, but with it, you're reading real information. Let me turn this off for a second. Let me show you an example, okay? Now, let's say you're looking at a normal chart, a normal candlestick chart, and let's say you trade support and resistance. And so here we had previous resistance that now you may consider, oh, this becomes new support. Maybe that's the way that you trade. Let's just say, for example, okay? Now, when we actually go and look at footprint and what actually happened here at the execution level of the auction, well, what do we see? We see sellers pushing back into this level or this area or previous resistance that is now being used as support. And on a candlestick chart, you may just see us moving into this area. Maybe it's choppy. Maybe we're kind of whiplashing back and forth. But on the footprint, they are failing to push price lower. And we are also seeing the other side or the counterparty of buyers begin to step in this area as well. We're seeing large volume being transacted at these lows, and price is failing to continue lower. This is telling us that sellers are aggressive here, but they are getting absorbed by passive buyers. And understanding that or reading it that way is completely different or different information than if you were to just be looking at, like, let's say a box on your chart and candlesticks wicking into a level. And when we get this type of confirmation that yes, this level is valid and we can confirm that by using order flow, well, then that is the edge. At the end of the day, though, it's not that candlesticks are wrong. I'm not telling you that you need order flow, okay? But candlesticks alone, they are incomplete. And if you're really serious about improving your trading or improving your existing strategy, then you do need to know what's actually happening underneath the chart, underneath these candlesticks. And if you want to see how I actually apply it in real time, I break it down daily and I build a full framework around this. Now, I don't necessarily trade support and resistance, but I'm just giving you guys an example, right, based off of what I'm looking at on the chart. But this is the basics to order flow. We are just looking at the market in terms of an auction. We're looking at the interaction between passive and aggressive orders, and we're thinking in terms of effort versus result. And in the rest of my videos, I go about how I'm actually applying this with the framework that I use and the framework that I trade. But the purpose of this video is just explaining the difference between only using candlesticks and incorporating the actual mechanics beneath it through order flow and understanding the interaction between buyers and sellers, because that's what's actually moving price. Price is not moving necessarily because of a pattern. It's moving because of the interaction between buyers and sellers, passive and aggressive participants in the market. All right, so first I want to start off with what is footprint, right? So trading with footprint is essentially trading with order flow. So why would someone want to use a footprint chart? It tells you the real-time battle between buyers and sellers at each price level, and it's allowing you to see who's in control, where liquidity might be hiding, and where trades are actually happening. So it can give you an edge that maybe a traditional candlestick might not be able to offer you. So I want to go over what it actually looks like. So on the left, we have our normal candlestick. You have the body, the wicks, you have the open, and you have the close. Well, a footprint candlestick is essentially the same thing, but you're seeing what's happening within that candlestick. We still have the body of the candle, the wick, the open, the close, but we also have numbers here. And I know what you might be thinking, oh my gosh, there's all these numbers right here. How can I even read this? The market's moving so fast. Calm down. Don't worry about it. It's not that complicated. And luckily for you, with the blessing of technology, you don't have to read all these numbers. There's ways that we can utilize these candlesticks without having to look at all the numbers realistically. We can use it to make better decisions in our trading. So the type of footprint candlestick that I use, and there's plenty of different candlesticks you can actually use when it comes to footprint. I personally like to use the bid and ask ladder for my trading. And what is that? So on the left side, we have the bid, and on the right side, we have the ask. What exactly does the bid represent? Well, the bid represents where limit buy orders were sitting, or where aggressive sellers executed their orders. The ask, on the other hand, represents where limit sell orders were sitting, or where aggressive buyers executed their orders. So just so that you have a little bit of a better understanding of the bid and the ask, the bid is the highest price where buyers are willing to pay, and the ask is the lowest price where sellers are willing to actually accept. So how does price move? In trading, you have two different types of orders. You have a limit order, and you have a market order. A limit order is just a passive order. It's where it could either be where you set where you want to enter the trade, it could be your stop loss, it could be your take profit. That is a limit order. On the other hand, we have market orders. Market orders are where you are executing at market. It's an aggressive order. You're just clicking the buy or sell button, essentially. So theoretically, if there were only passive limit orders and no aggressive market orders, price would not move. Why is that? Well, limit orders just sit there. They don't actually cause trades. They just offer liquidity. So trades only happen when a market order crosses the spread and hits a resting limit order. And price only moves when those market orders consume available liquidity at a given level. So to give you a visual understanding of what this actually looks like, I made a very simple representation of the DOM, and if you don't know what the DOM is, it's the depth of market. This is not a footprint candle. This is level 2 data where it's called the depth of market. And you have the bid and you have the ask. In this representation of the DOM, we have 20 orders sitting on the bid. It means 20 people are looking to set a buy order right here at 19,986. On the ask, we have 15 orders looking to sell at 19,987. If no market orders enter the market, price is not going to move. A market order is an order where you buy or sell immediately. It's at the next available price. You're essentially telling the market, I want in now, I don't care what the price is, just fill me on my order. And so what that looks like is, let's say we're sitting here at price, right? And you're looking for a buy. Well, if you enter in at market, it's going to fill your order at the next best available price, which in this case is 19,987. So you will be filled on your buy right here. On the other hand, if you were looking for a sell and you executed a market order at sell, it is going to execute that market order at the next best available price, and in this case, based off the example, that's 19,986. So your sell order would get executed here. Now that we have a basic understanding of the bid and the ask and what a limit order is and what a market order is and the difference between a passive order and an aggressive order, we want to then take a look at the anatomy of a footprint candle. On a footprint candle, we have a couple different things. The first thing that I want to talk about, being that this is a bid-ask ladder, is we have bid-ask volume. So what is bid-ask volume? So on the left, we have volume sold at bid, means aggressive sellers. On the right, we have volume bought at the ask. This means aggressive buyers. This is executed volume. These are not pending orders. This is not like the DOM. This is showing us what has already happened. One thing that we want to look for when we are looking at footprint charts is we want to take into account delta. And what is delta? Delta is basically buy volume on the ask subtracted by sell volume at the bid. And so if it's a positive number, it's a positive delta. It means that there was buyer aggression. If it's a negative delta or a negative number, it means that there was seller aggression. Now, you're not actually going to have to subtract and add these numbers real time. Luckily for you, like I mentioned earlier, there is a delta indicator that will just show you what the delta is for the candle. So you only have to look at one number. You don't have to pay attention to all the different numbers and add and subtract them. But in this example, we have a positive delta of 1,875. And how do we come to that? Well, we take the buy volume at the ask. If we add up all of these numbers here on the right side at the ask for the buy volume, it comes out to 5,375 executed orders on the ask. If we look at the left side, we look at the sell volume on the bid, it comes out to 3,500 orders executed on the bid. So if you take the buy volume and you subtract it by the sell volume, in this case 5,375 minus 3,500, that is how you get the positive delta of 1,875. You don't have to add or subtract these numbers in real time. Don't worry about it. We'll take a look at some charts later and I'll show you why you don't need to do that. But just a side note, you can also tell the total volume of the candle by seeing all the orders executed in the candle. So in this case, it's 8,875 because we added the ask and we added the bid together, and that's where we get the volume for the candle in total. The last thing that I want to talk about for a footprint candle is we have something called imbalances. Now, this is going to be a lot easier to show you once we actually hop on the real chart, just so you understand what an imbalance really is. An imbalance basically occurs when there's a large difference or skew between buying and selling at a particular level. So whether there was 3 times as many buyers than sellers or 4 times as many buyers than sellers at a certain level, that is called an imbalance. One thing that you need to know is you need to know that when you're reading a footprint chart and you're looking for imbalances, you are not reading it horizontally. We are not comparing 110 to 11. We are actually reading footprint charts diagonally. So we are comparing 0 on the bid to 122 on the ask, 12 on the ask to 312 on the bid. You don't have to really pay attention, like I said, to all these numbers here. The way that these trading platforms are set up with footprint charts is it makes understanding this information very simple and very easy to understand, and we're about to take a look at that once we get into the actual footprint chart. So let's go ahead and hop on the charts right now so you can get a better understanding of what exactly it is that we are looking at. All right, so here we are on the charts now. We are looking at the 1 minute on MNQ. As you can see, we have our normal candlesticks. This is what everyone sees typically when they open up a chart. Now, the difference between this is you can zoom in, and now we have our footprint chart. So this is happening real time. The market is currently open, and it's about lunchtime right now, Pacific Standard. So there's about a couple hours left in the market. But I want to talk about everything we just explained. So here we have our 1 minute candlesticks. You see all the numbers in here, and you see that we have the bid and the ask. Just a little bit of a refresher, if we are watching this candle right here that's happening right now, we have the bid and the ask. When orders are getting executed here on the bid, those are aggressive sellers executing their sell orders. When orders are getting filled here on the ask, it is aggressive buyers filling their buy orders.
So I've added something to my chart where it shows me the delta and it shows me the volume. So in this case, if you subtracted the ask volume versus the bid volume, you would have gotten a negative delta, which is why this is a red candle. In this case, as you see buyers push price up, we have a positive delta. Buyers are pushing price further up. The higher that price is moving, the more orders are getting filled on the ask, the more that buyers are stepping in and filling their orders at the next available price on the ask. So if you're in a red candle, like this candle right here, you're going to be seeing sellers hitting the bid. If you're in a bullish candle, you're going to be seeing buyers hitting the ask. So something I wanted to bring up, and I wanted to wait till we were looking at the actual charts, are imbalances. And as you've noticed, some of these numbers are highlighted. And so what does that mean? It means that there was an imbalance between buyers and sellers at that particular price level. I currently have it with a filter on, so it's only going to show me when there was 4 times as many buyers or sellers at a particular level in price. And the reason why I do that is because I only want to see strong price imbalances. So like, let's take a look at 42 and 31 here that are highlighted. It means that there was a 400% or more imbalance between buyers and sellers. And you can use that to make a decision when buyers are stepping in and they want to push price up, or when sellers are stepping in and they want to push price. There is something called a stacked imbalance. And it means when price is stacking these imbalances back to back. So I actually have an indicator here. It's called stacked imbalances. We'll turn it on and we'll go look for a stacked imbalance. So if we go over here on the chart, we have a stacked imbalance. Now, what does that mean? It means that buyers were hitting the ask aggressively, way more aggressive than sellers were present here in this candle. And so what ends up happening is it causes a stacked imbalance. When you see a stacked imbalance form, it typically shows that there is a lot of pressure towards one side. Another thing about stacked imbalances is they can sometimes be used as support or resistance levels, or sometimes price might want to come back and test those levels, but that's for another video. But this is the basics of footprint charts. It may look overwhelming at first. Yes, there is a learning curve, but I promise you, if this is something that you find interesting, if you like seeing what's happening behind the candle, footprint is a tool that can give you an edge that normal candlesticks can't. And when you're reading these over time, after watching some more of these videos, I will explain what you can look for in order to enter a trade. Now, of course, you need a strategy. You need to be able to identify key levels, and then you watch footprint at those key levels. You look for where buyers are getting absorbed, where buyers are getting exhausted, or sellers are getting absorbed, or sellers are getting exhausted. You look for delta to flip from red to green, and you look for volume to pick up or drop off, and that's how you can help yourself make decisions to take better trades, to avoid noise, and to have more precise entries when it comes to trading. When I first started trading, before I was getting consistent payouts, I had an entry model, and anytime I saw that entry model, I was just immediately taking the trade, and I was getting absolutely cooked. And I thought it was the strategy. I thought maybe the strategy doesn't work, so I went to different strategies. But what I didn't understand is that context matters more than any signal or entry signal that you may have. Now, most traders think that their edge is their entry model, but in reality, the edge starts before the setup even appears. So most traders lose because they treat every condition like it's the same market, but we have different environments, we have different regimes, and that's something that we need to take into account. So professionals define edge as environment plus location plus participation plus execution. Signals do not create the edge. The filters before the signals actually create the edge. And so what is edge? Well, edge is just positive expectancy over a large sample. So if you want to know the actual formula for it, it's win rate times the average win minus the loss rate times the average loss. And the edge is going to degrade when the win rate drops, when the follow through decreases, when loss frequency increases, and when chop increases variance. So environment is going to directly impact expectancy, and the same setup performs different across regimes. And so the way that a lot of traders like to look at it is they just want to know the entry model. What's the entry model? How do you enter a trade? And so they look for that signal, then they try and justify it, and then they enter, and then they manage damage. The correct way that we should be looking at this or approaching the market is first you classify the environment, and then you identify location, and then you confirm participation, and then you execute. The signal comes last, not first, and confirmation does not override context. So how do we classify environments? What type of environments are there in the market? Well, there's three primary market environments. The first one is initiative expansion, the second one is balanced rotation, and the third one is low participation or compression, or what some people may consider chop. Now, all trading conditions basically fall into one of these three states. So your model most likely does not perform equally across all three environments. So what is initiative expansion? Initiative expansion is a directional auction where price is discovering value. These are things like trending days, or where we see price essentially have higher time frame alignment, the breaks are going to hold and extend, pullbacks actually resolve, and there's acceptance outside prior range. And there's also follow through after imbalance. And so in an initiative expansion, the best type of models for this type of environment are going to be continuation models. They're going to perform best. And you can use reversal models, but they're going to require extreme location. In this type of environment, you have lower chop, you have cleaner invalidation, and you're going to have clear directional bias. Now, what is a balanced rotation? Well, a balanced rotation is essentially where we're in a range. It's where you have two-sided auction around an established value. So some observable characteristics of this are going to be repeated rejection at the extremes, mean reversion behavior, and where breakouts or breakdowns fail, and there's going to be overlapping structure and both sides are active, meaning both buyers and sellers are active in this area. The best type of model fit for this is going to be the reversal at extremes. Continuation models are going to degrade in this type of environment because there's more false breakouts. So you're typically going to see higher whipsaw, smaller average extension, and more false breakouts. Now, what is low participation or compression? This is essentially chop. This is essentially where there's insufficient participation to produce sustained auction outcomes. So some things that we might notice in an environment that is low participation or compression is there's tight overlapping candles, there's multiple micro breakouts that fail, and then there's imbalances without continuation. The tape may even be slow, liquidity may be thin, and there's no acceptance outside of structure. And in this type of environment, most models will actually degrade, and edge is statistically reduced because there's high noise, there's poor follow through, and there's going to be frequent stop outs. Now, I trade Orderflow. So Orderflow is an amplifier, but it measures participation. It does not create participation. And so in expansion, it's going to confirm direction. In rotation, it shows that two-sided activity or the activity between buyers and sellers. And in compression, we're going to see events occur without any sustained movement. But order flow reliability decreases in compression when participation is low, when the follow through is just totally absent, and when the auction is balanced, at least for the way that I trade it. Now, the common mistake that people might make is they may say that they entered a trade because they saw a stacked imbalance, or they saw absorption happen, or they saw a delta flip. And the assumption is that the signal guarantees follow through. But in reality, signals represent short-term activity, and the follow through requires structural alignment. So a valid signal in a misaligned environment has lower probability of extension or lower probability of working out. So then how do we think about these environments? Well, we're going to go over something called the model environment fit matrix. We're going to talk about continuation models, reversal models, and scalping models. In a continuation model, like I mentioned earlier, it's going to be strong in initiative expansion. Why? Because the directional auction is going to actually provide us the follow through needed for a continuation model. Pullbacks are going to resolve rather than reverse. There's going to be acceptance that supports the continuation, and risk can actually be defined under structure. So the edge driver for this is going to be sustained participation and structural alignment. Now, the continuation models are weak in balanced rotation, and the reason why is because breakouts will frequently fail. You're going to have two-sided activity that limits that extension for a continuation, and you're going to have mean reversion tendencies that reduce follow through. And lastly, trend logic conflicts with range logic. So the edge degradation is the win rate drops due to failed continuation attempts. So if we notice that we're in a balanced rotation, we may want to reconsider trying to take a continuation model. Now, a continuation model is going to be poor in compression because there's no sustained displacement. We need displacement for a continuation model, and there's going to be micro breakouts that repeatedly fail. The follow through is going to absolutely collapse, and targets rarely get hit before reversion. So if you're trading a continuation model in compression, you're going to have frequent small stop outs with limited expansion potential just due to the environment that we're currently in. Now, for a reversal model, it's a bit different. So it is selective in initiative expansion. And the reason why is because initiative pressure is dominating. So most counter trend signals are absorbed, and reversals require exhaustion plus failure of continuation. So a reversal model in initiative expansion is really only going to be valid when there's higher time frame extremes that we can watch, and there's extended moves relative to the session, and there's clear acceptance failure. So the edge driver for this is auction failure. It's not just a footprint signal, it's not just a signal, we're watching the auction. Now a reversal model is going to be strong in a balanced rotation at extremes. Why? Because auction rotates around value, so the extremes often reject, and there's liquidity pools sitting at range highs and lows. The mean reversion tendencies are structurally supported that are going to help with reversal models. So two-sided participation is going to create those opportunities to fade. But again, in compression it is weak because the extremes are poorly defined, the breaks are going to lack commitment, rejections lack displacement, and noise overwhelms structure. So again, even in compression, when you're using a reversal model, there's going to be frequent small reversals that do not extend. If we decide that we want to have a scalping or micro model, then the way that we have to understand this is a little bit different, because in a scalping or micro model, it's moderate in initiative expansion. And the reason why is because the trend provides directional bias, there's micro pullbacks that offer continuation entries, and there's going to be short bursts of momentum that do exist. So the only limitation with this is that late entries do get punished if we're chasing. And it's also going to be moderate in balanced rotation because both sides are tradable at extremes, the micro mean reversion exists, and smaller targets will fit the range conditions. But the limitation to this is that the profit ceiling is capped by the range width. If you're scalping or doing a micro model, it's highly sensitive to compression or low participation. And some characteristics of compression, again, are just overlapping structure, reduced range expansion, there's going to be failed micro breakouts, there's inconsistent follow through, and thin or erratic liquidity. And it actually affects scalpers the most because scalping relies on small bursts of displacement, and compression reduces displacement magnitude. And if your average win is going to shrink faster than stop size, then that's going to cause a problem. Signal frequency stays high, but expectancy erodes rapidly, because mathematically, if we're in a compression, if your average win drops from 5 points to 3 points if you're scalping, but your stop remains 4 points, then your expectancy is going to collapse, even if the win rate remains similar. So compression does not necessarily eliminate signals for scalping or micro models, but it's just going to degrade the payoff efficiency. So if you have a high trade frequency, but you have low displacement, it's going to basically give you death by friction. So the point is just that no strategy is regime agnostic, and model performance is entirely environment dependent. And if you do not classify environment, then you are unknowingly changing your expectancy curve. And so knowing this, then we have to understand that there are times that we should trade and there are times that we should not be trading. And not trading is part of the edge. Not trading is a position. And so structural no trade conditions are going to be things like
multiple consecutive failed breakouts, or overlapping structure with no expansion, repeated return to value, no higher time frame alignment, no clean location, inability to define continuation path. And so when 2 or 3 of these things occur, expectancy is degraded. So passing on these types of environments are going to preserve our capital distribution. So then what is the decision tree that we have to really consider when we're trading and we're watching the market? Well, the first step is that we have to think, what environment are we currently watching? What environment is present? Now, does my model fit this environment? And is there meaningful location for me to execute in this environment? And lastly, is participation aligned with structure? If the answer to any of these questions is no, then you pass. You just don't trade it. Because even if you see your signal, you do not trade it. Or your entry model or whatever, you do not trade it. Why? Because execution is conditional. And our participation in the market is going to be optional, but our risk exposure is controlled. We want our risk exposure to be controlled. And so when you're having a strategy, your edge includes invalidation conditions. Your edge is going to include when you should and should not trade. And you need to define when your edge works or when your model works, when it degrades, and when it is inactive or you shouldn't even be trading it, regardless of if you see an entry signal on your chart. Because if you can't define when your model is inactive or when you shouldn't be trading it, then you don't have an edge. You have a pattern preference. And what professionals do is they increase aggression only in aligned environments, and they're actually going to reduce their exposure in misaligned ones. And the final principle is essentially just signals and entry models are execution tools. Environment is the filter, and the filters are going to protect our expectancy, and they're going to protect us on our equity curve. And not trading is not hesitation, it's just statistical preservation. It is a position, it is part of the edge, and so we need to constantly think and remind ourselves that there are times where statistically our model or whatever we're trading may not be in the right environment. And if it's not in the right environment for us to try and execute that model, then we pass. We save ourselves money lost or a headache, or you trying to get out a drawdown, because edge is not frequency, it's conditional participation. So our participation in the market needs to be conditional, only when things align, only when the environment aligns with what we're trying to do, only when our model, whether it's continuation or reversal, makes sense for what we're trying to do. Because oftentimes, let's just say you have a reversal model that you're trying to force on the market while we're in initiative expansion, and you just keep going short when the market is pumping, then you're going to get absolutely destroyed, and vice versa. Now, like we went over, reversal models do work sometimes in initiative expansion, but you have to be selective with it, and it requires extreme location or understanding on the higher time frame extremes where that location may be for us to try and attempt a reversal model. And the same goes for if we're range bound for the day and you keep trying to trade a continuation model. Let's say your model is you trade breakouts of the range, and every single time the market goes to break out of a range, you enter a trade for a continuation and we snap back into the range. And you lost going short, then you lost going long, and then you lost going short, and then next thing you know, your account's gone. So the whole purpose is, if you have an entry model and it works for you, great. But just understand that we have different market environments, and realistically, your model probably isn't going to work the same in all of the market environments. So we need to be selective on when we do decide to participate, and our decision tree needs to be in the correct order so that we save ourselves from losing money that we didn't need to lose. We're going to talk about premium and discount today through auction market theory. Now, some context is, I know that most traders are actually going to recognize premium and discount through ICT content, and that it basically made it popular as a concept. I get it. In this video, I'm not here to debate who invented it or taught it. I'm just going to explain essentially what it represents, and we're going to view it through auction theory and order flow, and then I'm going to talk about some tools that I use and how I actually use it on a day-to-day basis, and then we'll take a look at the charts so you can get a better idea on how I use it in my trading, and maybe it can help you. So the auction market theory foundation. The idea is essentially this. Markets are auctions. So what is the market's job? Well, the market's job is to facilitate trade, to discover value, and then to incentivize participation when imbalance occurs. So price moves to essentially solve imbalance. Really, in the market, we have two major states of the market. We have a balanced market and we have an imbalanced market. So what is a balanced market? Well, balanced markets are essentially where you see price with an established high and established low, and we're essentially rotating in between the mean. It's where we have an agreement on value, where we have that rotational behavior, and then you'll often notice that there is large accumulation of volume in these areas. Now, an imbalance is different than a balance in the sense where there is a disagreement on price. Either there are more buyers than sellers, or there are more sellers than buyers. They are not equal. They do not agree on price, and that is what actually causes price to move or displace. So in imbalances, we have directional movement, and then oftentimes price is then searching for liquidity. Now, premium and discount only make sense once a balance exists, once there is an established range. So what is actually an established range? Well, an established range is going to form when value is accepted, when the extremes of that range are defended, and then volume builds near the middle. So this range becomes reference for relative value. What you can look for to make things easy are significant swing points. I'm not talking about every little single swing point on the market when you're looking, and it is slightly relative to time frame as well. But in this case, if we were to open up this chart, this is a 5-minute chart on NQ. And where are the most significant swing points for us to establish the range? Well, it's going to be this swing low and this swing high. So we mark out the high of the range, the low of the range, and then we have the middle of the range, and then this now becomes price trading within the range, within the high, within the low. Now, when we're talking about ranges, we need to talk about value and fair value. A lot of traders may be familiar with this. It's expressed through volume profiles. Now, value, the way to understand this within the range is this is where business was actually conducted. So this is going to show up as POC, the value area. We have value area high and value area low. And then we have composite distribution throughout this area. So value is not an opinion. It is volume. So we can notice where the value area is just by throwing on a volume profile. That's probably the easiest way to do it. Now, we need to define where's premium and discount, because we know where the value area is at. Well, where's premium and discount? Once the range is defined and we have the value area, now anything above value is going to be premium, and anything below value is going to be discount. Now, we do have a 50% of value area, and why does this exist? Well, the 50% level is going to approximate balance. It's going to represent mean reversion tendencies where price is going to rotate between here. And it's often going to align with value metrics. So this concept itself really exists across Wyckoff, auction theory, market and volume profile, and of course, ICT concepts. Now, you don't necessarily need the volume profile. You can still identify premium and discount without a volume profile, but it just helps us establish where the value area is. Now, something that's important to note is premium and discount is context. Premium and discount is not a buy signal, it is not a sell signal, and it is not a prediction of price. It is just a location filter. We just have to understand where are we on the charts, where are we relative to value, and it can be used basically as a risk compression tool. If I want the best risk to reward for a trade, I should be looking for longs and discount and shorts and premium. And it's a way to avoid chasing price. In order flow, there is responsive and initiative order flow. So in discount, what we're looking for is responsive buyers. We're looking for sellers to get absorbed, for sellers to fail a continuation, or for pressure or delta flips to bring it back into the range or to the equilibrium or even back into premium. In premium, we're essentially looking for the same thing on the other side. We're looking for responsive sellers. We're looking for offer stacking or buyers making failed breakouts or trapped initiative buyers. So what is that? That's basically where we're in the premium of an area and buyers are stepping in trying to push price higher and they fail. Now those buyers become trapped and then we can potentially turn around. The way that I use discount and premium is I use fibs. Now I use the Fibonacci retracement tool, and it's how I define premium and discount. Everyone has different levels. You know, some people have different levels than me. That's fine. The levels that I personally use on my range fib is the 0.5, the 0.62, the 705, 788, the 886, and the 1.1. Now the logic behind this is that the 0.5 or the middle line or the equilibrium, whatever you want to call it, that's going to mark the transition between premium and discount territory. Now, what I'm really focusing on when I am looking at these fibs is I'm focusing on the area between the 705 to the 886. This is really the sweet spot for me. This is where I like to focus on reversals or look for responsive behavior as long as the higher time frame context is going to align. If I'm just drawing out range fibs everywhere and totally ignoring higher time frame context, then it does not matter. We need to understand on a daily, on a 4-hour, weekly, monthly, whatever, higher time frames, we just have to understand where is price going on a higher time frame. If, for example, we look at the daily, the 4-hour, the 1-hour, and they are all bearish, okay, then we are more likely to be looking on a smaller time frame for areas in premium of ranges to continue that bearish momentum further down. You wouldn't necessarily be bearish on higher time frames and then be looking for discount all the time, trying to just buy every single discount. You're just going to get wrecked because you're ignoring higher time frame context, essentially. One of the most important rules, though, when it comes to these fib levels is the 886 is one of the most important levels for me. And the reason why is because if price actually closes beyond the 886 level, I essentially treat that range or that area as invalidated, and a touch of the 1.1, which is past the swing high or past the swing low, is likely at that point, because at that point I'm essentially expecting a continuation of momentum and I'm not looking for a reversal anymore. So these levels are just defining location. These are not entries. This doesn't mean that you draw a fib out on your chart and then anytime price touches into a 705 or a 788 or an 886, that you're just going to enter there. So let's say that we have our value area, we have our premium, and we have our discount. Well, typically, what will usually happen is the 705 to the 886 will either be in premium or discount. Now, if we draw it from swing low to swing high, we have our zone here in discount, this area between 705 and 886. If we go from swing high to swing low, now we have our range here where we have 705 to 886 and it's sitting in premium. Even without the volume profile, we can still do the same thing and we get our areas. So then it makes it a little bit smaller. We're looking in this area as premium. We're looking in this area as discount. So if you ever look at my charts and you see fibs like this on my chart, now usually I don't draw out all the rest of this stuff. This is just to explain it, but I'll usually only draw the fibs. When I draw the fibs, I usually don't draw fibs on both sides. And the reason why is because I usually have a bias on which way we're going. So if my bias is bearish, let's say in this scenario, we had a large drop. My idea for how the market is going to react off of that is we're going to rebalance higher before we continue our move down. Then I probably wouldn't be drawing a discount zone. I'd probably only go from swing high to swing low. And then I'd be looking for premium at another entry, or swing high to swing low, looking for premium at another entry to go lower. When you do see them on my chart, if I ever post it in like my daily outlooks or you see it when I'm live trading or whatever, it's not very often where I'm going to be drawing them on both sides unless we have been ranging for a very long time and we're kind of in the middle of a larger time frame consolidation area. But more often than not, when I'm drawing it on like a 5-minute time frame or a 15-minute time frame, I'm usually just drawing one side because I don't want to confuse myself. Now there is something else that I actually use when locating where am I actually looking for trades in premium or in discount. And the reason for that, before I tell you what it is just because sometimes if the range is large enough, the area between the 705 and the 886 could be massive. Like it could be 100 points, 200 points, it can be huge. And so we can't just like give ourselves a 100-point area. We got to try and narrow it down a little bit and focus in a little bit. And so what I use for that is I use something called the dark pool decoder. It's an indicator that I have, and it essentially will draw out a zone inside of premium or discount. So the purpose of it is just to find a focus zone inside of that 705 to 886 region. And then it narrows the attention when we're looking at location or where that responsive order flow or initiative order flow should happen. And we're looking in a smaller area. So the way that I actually use it is and this is the dark pool decoder. The way that I actually use it is I will mark out a swing low to a swing high, and it will fall in between 886 and 705. Let's say we're somewhere over here on price. I notice that we are now establishing a range. We've put in a significant swing low and a significant swing high. Well, I am going to mark out my fib. I'm going to understand where value area is at, and then I'm going to use this to draw out a zone. Now, you don't need this, but I love it, so I use it. And what I'm looking at is I'm looking at this zone. Now, this zone technically has 3 levels to it. The first level is level 1, this is level 2, and this is level 3. I'm looking for reaction out of this zone at any of the 3 levels. If price ends up closing through this zone on the time frame I'm looking at, usually like a 5 or a 15 minute or sometimes a 1 hour, if price closes on the other side of the zone, it's invalidated. I'm no longer looking for a reversal. I'm shifting expectations towards a continuation lower past the zone, but I'm just trying to see if this area is going to hold, if this is my bias. Now, what I mentioned earlier is if my idea of price is for us to make a large move down, rebalance some of this move before we actually continue and make a new low, then I probably wouldn't be using it here. Because why would I be looking for longs when my bias is bearish? So then in a true scenario, what I would normally do is once we put in that significant swing high and we put in a significant swing low, and I may draw it even if it gets down here, and then if it doesn't reach it and we make a new low, then I will extend it. Now what happens is now we have an area of premium where we can be watching as location reference to understand where might be a good idea to take shorts. And it's even better when it's above previous swing highs. If it's above this swing high, or if it's above this swing high, we're watching this area to see if sellers are going to essentially defend this and buyers are going to fail to break out. And we are in premium. It's a good area to look for shorts if our bias is to continue lower to take the lows. One thing is that this tool itself does not predict price, okay? The point of this is not to predict price. The point of the fibs is not to predict price. It's just to help with structure expectations. It's just to help with how far do I think are we going to dig back into this move before we continue. Something else that I actually use when it comes to premium and discount is I use a volume profile. What does a volume profile do for premium and discount? Well, it does a couple different things. One is it mainly adds confirmation. So on a volume profile, when you're determining premium and discount from an established range, it's going to show you acceptance at value, rejections at extremes, and failed auctions. So in high volume areas, we're going to see agreement or consolidation or even some chop. And then in low volume areas, we can see rejection or even fast movement straight through it. So this just strengthens the premium and discount context, because the way that I'm actually using this is every time we have an established range, the value area is going to be where the most volume's at. And more often than not, in that area where the most volume is at, you're going to find it's basically in the middle of the range. Once we start getting out of the value area, so if you can't see it, this middle line is basically the POC. This is value area high, and this is value area low. So if above value area is premium and below value area is discount, then something that I'm looking at is I'm looking at low volume nodes. we have a low volume node here, we have a low volume node here. So what happens in this low volume node? Well, we bounce off of value area low, we extend past it into the low volume area, and then we pump back up. Same thing happens up here. We bounce off of value area high, and then we come up into the low volume node and we can't get past it, and we end up rejecting back down. You can use like this type of volume profile because you can still see the low volume node here, and then, you know, volume drops off here, but I don't like using these big blocky ones. It's a lot easier to identify low volume nodes when you're using like a normal volume profile, not a fucking shitty trading view one. But this is good for essentially determining value area high and value area low. So why does this matter for order flow traders? Well, order flow essentially is just going to tell you who is active, who's defending, who's trapped, and then premium and discount is going to tell us where to narrow our focus. It's going to improve location in terms of making a trade, and then it's going to reduce over trading. I mean, there's plenty of times where if you don't understand location, you can have a great entry, you can have the right idea on where we're actually going to in terms of draw next, but you just get stopped out, or you entered a little too early, or whatever. Understanding location when it comes to where you should actually be taking the trade is going to help tremendously. It's going to help you pick the right times. It's going to help you avoid over trading. We realistically don't want to be trading the middle of a range. We want to be trading the extremes. Now, if you use order flow and premium and discount together, then it's going to create cleaner execution, and you're going to understand where we actually are in relation to value. Now, when people use premium and discount, there are common misapplications and there's common misunderstandings. One of them is you just draw a bunch of fibs all over the place, or you mark out premium and discount all over the place because you have so many different time frames, you have all this different shit, you can mark out established ranges all over the place. And then what happens is people will just like blindly buy discount and they'll blindly sell premium, but they're ignoring close beyond invalidation levels. They're treating fibs or other zones they may have in premium or discount as predictive. These are context errors. They're not strategy failures. You just need to understand that if you're using premium and discount, it must be used with context of higher time frame alignment. Essentially, where are we going? You can't just mark out a 1 minute range on a 1 minute time. Like, you can't go on a 1 minute time frame, mark out a range, and then we look bullish on a 1 minute time frame. So you're going to be buying up the discount on a 1 minute time frame range when all of the other time frames, 5, 15, 1 hour, 4 hour, daily, we're all obviously going lower. The draw is lower. Why are you going to be buying 1 minute discounts? Doesn't make any sense. So just make sure if you're drawing premium and discount, you zoom out a little bit. You zoom out first, you do top-down analysis to understand where it is that we are actually going before you start just blindly buying or selling premium or discount. So the final takeaway before we hop on the charts is just that premium and discount is auction logic. It is relative value, and it's just awareness of location. And it works best, at least for me, when it's combined with consistent measurement, meaning that you are drawing and determining premium and discount the same way every time. And if you combine it with volume, and then once we actually enter into those areas, if you use order flow as confirmation for the actual entries or the trades, and just understanding what it represents is going to make execution like way simpler. All right, so let's say that today, this is today, by the way. So it's currently February 3rd, 2026. This is actually a perfect example of premium and discount. Why? Because here we are in this range on a higher time frame. We're bouncing back and forth, okay? We go from discount to premium to discount to premium. Now, Sunday opens up, we push further into discount. Now, the idea is that we're going to come back to the equilibrium and we're going to push into premium. Now, if our bias is bearish, then what are we going to do? Well, we're going to take a significant swing high and a significant swing low, which is going to be the top and the bottom. We're going to extend it to the right for where price is going to basically print. And we're going to understand that we are watching this area. We're essentially watching this area, okay? I'm gonna change this to orange so it's easier to see. If price were to get past the 886 in this scenario where we're pumping, then we're probably gonna come up here and hit the 1.1. What I'll do then, if you ever see my other charts, you may see boxes on it and not know where they're coming from. Well, this is where it's coming from. If we were to take the swing high to the swing low, and we now create a zone. Well, in this zone, this is essentially where in premium I'm looking for us to potentially turn around if my bias is that we're going to go lower. So this morning specifically, when we were opening up, I knew that we were here and I knew that we made this large move up. So what was my bias for the day? Well, it was to go lower. Now, my bias would have flipped if we got above this area and this area. Then I would have started looking for price to potentially go higher. Now, time out. Let's say, oh, well, you already know what happened this day. You just cherry picked this shit. Okay, fine. But this happens every single day, and I'm going to prove it to you right now. So let's say, let's do this. Let's go to replay mode. On replay mode, let's go back to a random day. Let's go to November 20th at midnight, okay? Here we are in November. What does it look like here? Well, it looks like we probably are going to go lower. Why? Because we have price coming up. We now make a lower high, lower high, lower high. I would be looking for us to basically come lower to take these lows. Okay, so that is on a 1 hour time frame what I would be looking at. This would be the draw. So let's determine where should we actually be looking for a trade. So in this scenario, where is our range? Well, I would be going from this significant swing high here to this swing low here. I'm going to extend this out. We're already a little bit in premium, but we want it to go further into premium. And then what I'll also do is I'll just take this. I'm going to mark out the swing high, swing low. We're going to draw our box. And we're going to put it right here. And this is the location that I'm going to be looking for to go short. And when we do go short, where are we going to target? Well, we'll target right here. Let's play it out and let's see what happens. Now, in the event, because I don't know what's going to happen, I just chose a random day. In the event that we move up here and then we get past the top of this zone and we get past 886, I'm no longer looking for us to go lower. I'm then looking for us to go higher, and I'm shifting my expectation to a bullish bias. What I'm looking for though is once we do get in here, I'd be watching order flow to determine whether or not we're going to turn around. Now, sometimes we may never actually get up into the zone. Now, in this case, it played out kind of quickly. What did we do? Well, we came into premium in the 0.62. We came into our zone at the first level and we dropped. Now, you might be saying to yourself, well, Thrax, you knew what was going to happen that day. Well, no, I didn't. But just to prove a point, I'm going to do it again. It literally happens every day. This is how I frame my bias for direction. Besides using just normal market structure, because my bias at this point was that we were going lower. This is an obvious bear trend. Lower highs and lower lows. You don't have to be a genius to figure that one out, but this is how I frame my ideas every single morning. Now we're doing it on a 1 hour time frame, but it's how I frame ideas every morning on where I should actually be looking to take a trade. So you know what? Let's drop down to a 15-minute time frame. And let's go choose a new day. We'll go back to October. We'll go to, I don't know, October. No, it's a Saturday. We'll go to Tuesday, October 14th. Okay, so here we are. Before we even start the day, and usually I draw these in the morning after London and Asia have already been established, but I'm just going to show you it happens basically all the time. Let's just say that we take this swing low to swing high, okay? Let's move it to the right so we know what's going to happen the next day. We're going to be watching this area here. Standard, we'll make it orange so it's easy to see. So let me just draw it from right here to right here. So in this scenario, I'm looking at this area, okay? And then let's turn this off. So heading into this day, if I were to be bullish, which I didn't even do any type of, let's go look for a second. Okay, well, in my mind, yes, we did have this drop lower, but
just for the sake of the video, let's just play out what happens in this area. Now we can totally just be coming down way further than this, but I'm just going to play it out. So let's say we start playing out the 15-minute. I'm not looking to take a long at all until we get into this area. Okay, so what happened right here? Here we are in our established range. We have the high and we have the low. Now, I would also show you what it looks like on a volume profile, but I can't really do that right now because we're just on TradingView and their volume profile kind of sucks. We're just going to talk about the fibs and the zones. But what I would be doing in this scenario is we have the low and the high. So what happens if we are bullish? We think that price is going to potentially come and fill this gap, which is a new week opening gap, and then potentially bounce and come back up. Then where are we looking? We're looking in this area to take a long, or this area to take a long. If price gets below this box or below this 886, then at that point I would imagine that we're just going to continue to the 1.1. So as price comes into here, we're on a 15-minute time frame. If I'm watching this at 6:45, which is 15 minutes after open, and I'm watching this happen, what am I looking at? Well, I'm looking at order flow. I'm seeing what's happening in this candle right here. I'm seeing what's happening when we got to these lows, and I'm seeing what this next candle is going to do. Now this is giving me context for location on where I should actually be looking to take a long position. We're in discount. We're in the area that I'm looking for. We touched into the 705, and now we can say the location is here. Let's look for confirmation to take it higher. Now if you did that, well, great. You got a long, and you probably made some money. Now, in the event that we came down here, we did a little bounce, I mean, you would be watching on order flow for confirmation. Again, you're not just going to take random trades because they're in this area. This is just giving you an idea for context, okay? And again, people are going to say like, oh, you're cherry picking these. I'm literally picking random days. It happens like every day. I do this every morning to determine where do I think we're going. And just so that you know I'm basically not full of shit, well, let's start marking some of these out, okay? So let's say that we go from this swing low right here. Let's say we go from this swing low right here to this swing high. Well, where are we going to drop on this box? I don't know, right there, boom. Okay, let's draw out a fib. If we go from here to here, where are we? Where did we touch? The 705. Okay, well, if that's not random enough for you, let's go look for a different one. Let's look at this one, okay? Here we are, we have our range right here. From here, this swing low to this swing high. Where do we touch into? The 705 and 788. We're bullish. Our bias is bullish. Okay, well, what's going to happen when we go from swing low to swing high? It literally happens all the time. And this is a great way, as long as your bias is correct, this is a great way to determine a good location to look for your reversals. A good location where you should actually be looking for the trend to then continue on that pullback. Now again, you don't need this tool. It's great, it'll help you out, sure, but let's just imagine we don't have it, okay? Now let's say that we're just looking at this. Well, then we're just gonna be looking at this area. That's it. Happens all the time. To the downside too. The point of this video is just to have you understand how I actually use premium and discount. I'm using it as a location filter to understand where it is that I should actually be looking to take trades. Just go with the higher time frame bias, find your discount areas, find your premium areas, and then just understand where you should actually be taking the trade. If you do that, then you use order flow as confirmation to actually take entries on smaller time frames. You're gonna find that it really helps. In this video, I'm gonna be going over an indicator I've been working on for a pretty long time. So this is the NQ volatility range indicator. It's called NQ volatility range. Now, this indicator is specifically only for NQ. The reason why is because this indicator is essentially taking statistical data and then creating zones or areas that we watch based off of
8 years of NQ data that I ran. I basically created like a script to determine how far away does price typically deviate above Asia session or below Asia session on a given day, but it's only for NQ. So I had like 8 years of open, high, low, close data. I ran some tests, and then this indicator was basically born. So we're going to go over the purpose and the logic and then the proper use of it. And then we're also going to talk about a little bit about how I use sessions a little bit, because this is the whole point of the indicator. Really comes down to how I actually determine kind of what I'm expecting to happen on the daily profile or what's going to happen during New York session. And that all comes down to a daily candle. So daily range expansion, right? So most traders, they might treat volatility as random, or most indicators might have, fixed levels that are projected, and they ignore regime changes, they ignore volatility changes, and they're just posting static levels. And sometimes traders might enter too early because they don't understand where expansion statistically will get exhausted. And then Asia session is often ignored despite anchoring the daily auction. So what do we typically see in a daily candle? Well, usually what makes up a daily candle? Sessions. Now, the way that I think about it is that we have Asia, London, and New York. You can say that there is also CBDR. There's different Asia sessions that open. There's different sessions that open throughout here. You can have New York AM, lunch, New York PM. But realistically, if this is a daily candle here on the right side and we have the open, the high, the low, and the close, what usually makes up a daily candle, just to keep things simple, is Asia, London, and New York. What is the indicator doing? Well, the indicator is basically marking out our Asia session, and then it's creating levels above and below Asia session for what the statistical averages are on how far away we're going to expand lower or expand higher from Asia high or Asia low. So when we have the indicator here, we have Asia session, we have Asia high, Asia low. There's also the middle of Asia, or the equilibrium of the range. And then we have quarters, quarter one, quarter two. This is basically 25% or 75%. Now the goal is to basically understand where might this daily candle wick get created. So we have these different zones. We'll go into them, but if you just kind of look at this picture, we expanded above into one of our zones. We reversed down, and then the move got exhausted in this other zone. Now that's great. I mean, it could have been cherry picked. It was cherry picked, but this is just trying to give you an example of how this is going to look when it works properly. Now we do need to understand though that since this is based on statistical averages, that there are days that are outliers to the data. So if on average a daily candle moves, let's just say 400 points or 350 points, we can have days during that time where a daily candle, some catalyst might happen and it moves like 1,000 points for the daily range. Then obviously on the outlier days like that, the outliers to the data, the way that this is used is different, because this is calculating basically the averages. On average, on a normal type of volatility day, where are we typically looking for price to basically expand, get exhausted, and potentially turn around? It's not predicting direction, okay? It's just defining statistically meaningful locations relative to Asia high and Asia low, or Asia session in general. Now, why do we use Asia session? Well, I use the Asia session as the daily auction anchor because it usually is going to align with roughly the open of the daily candle in most cases. And Asia session establishes the initial balance of the day. There are days where we expand during Asia session, sometimes on Sundays or whatever, but Asia creates the range, and then London and New York act as expansion and distribution phases during the day. And then over years of data, price consistently reacts relative to Asia high and Asia low. So that's why I use Asia session as the daily auction anchor. It's just an observed statistical behavior just across thousands of sessions when I ran the data and I created a script to basically determine this information. So sessions are a really big thing when it comes to how I set up my day for trading. I allow Asia session to form. I see what London and Asia did prior to New York Open to then get an idea on what I believe New York Open is going to do. If you're ever in the Discord and you see my daily outlooks and, I'm drawing things out and you're thinking to yourself, why is he drawing this out? It's because I'm looking at this. I am looking at Asia session and London session, and then I'm trying to determine what is the most probable thing for New York to do when New York opens up. So that comes into a session rotation model, basically. So how the three sessions typically will interact with each other. Like we mentioned earlier, Asia session will typically define the balance and the range. And then London can often create the daily wick, or it can just be a manipulation away from Asia's range. And then New York often resolves the true directional move or is the continuation. So keep in mind, these two images are different days. Now the model looks the same. We have Asia session here. We have Asia session here. London deviates below before New York takes it back up. There are days where we have Asia, London, and New York all moving in the same direction without any of the highs getting taken or any of the lows getting taken. And there are also days where the sessions just go sideways. We have Asia, London, and New York. So this is not going to happen every day. We're not trading certainty. We're just trading statistical tendencies on where this might actually go. So what is the indicator actually doing? Well, the indicator is locking in Asia session. It's locking in the highs and the lows at the close. And then it's using the daily average true range to define expected volatility. So up here on the indicator, right now this indicator is using an ATR value of 20. And so if the daily range, let's say from a 20 ATR is 278 points, well, then it has a mathematical calculation to determine the up projections and the down projections for these zones. They are not symmetrical. They are asymmetrical because the data shows that when price deviates below Asia and deviates above Asia, they are not the same. One is larger than the other, and that's really important. And that's part of the reason why this indicator, to me, is pretty cool, because somebody can sit here and basically define Asia session, and then they draw a fib going up and a fib going down. I actually have an indicator like that. It's called session range projections. But there's no statistical data backing that. So I think this one is a lot more accurate, and that's kind of where this idea came from in the beginning. So the zones print after Asia session is established, but they do not repaint during the session. So the moment that the session closes, these levels here are going to print, and they're going to stay there the rest of the day. Then the next day, it will recalculate based off of what the ATR is now, and then it's going to repaint the zones and send them out on your chart basically, and they're going to stay there the whole day. So it's a rolling calculation that is going to adjust to volatility as the market regime changes, or volatility basically contracts or expands as the week moves forward, as the month moves forward, so you never really have to change it. It's adjusting it automatically itself every day. Now, where did I get the statistical foundation for this? So like I mentioned earlier, I did download it was 15 years of open, high, low, close data on a bunch of different time frames for NASDAQ. And then I focused more so on, as volatility's been building, in the more recent years for the NASDAQ, because more money's involved. It measures the average expansion beyond Asia high and low, and it's using volatility normalization to stay relevant across regimes. So that's what I was mentioning earlier. So it's going to prevent erratic behavior through change clamping. So it's a rolling calculation. They are not arbitrary fib levels. These are volatility adjusted statistical reference areas. So there are different zones here, and they have different names for them. And I'm going to go over that right now. So typically there's, 5 levels here. We have level 1, we have AVR minus, AVR plus, and then we have a max level. What AVR stands for is it basically just stands for average volatility range. So the way that we use these, or the way that we understand them, is that when price deviates away from Asia session, the first place it's going to touch, or the initial expansion area, is going to be level 1.
Level 1 has two parts to it. It is this gray zone you see here, but then there is a red area in the gray zone. It's basically like the OTE of level 1. Usually London will be the first to reach this area because after London attacks Asia highs or Asia lows, once it opens up, it's going to expand into level 1. AVR minus is this dotted line here. Now, on days where we're not really moving or expanding in a directional manner, we're typically going to stay within AVR minus. We're going to stay between this dotted line and this dotted line. This area right here, AVR, is the average expected expansion right here. So this is the average expansion that we'd usually see when price will deviate away from Asia session. Now, AVR plus is just the extended expansion. So if we do have a big move that day, we'll likely reach AVR plus, and then we'd be looking in this location for potential exhaustion or for price to start turning around, depending on context, depending on higher time frame structure and the higher time frame draw, things like that. And then the max level is statistically stretched territory. So price realistically should not get past this area. And if it does get past this area, then something happened that day. It's an outlier to the data. It's very rare that price does get past this area. And when it does, it's usually a massive day, a really big move. It's like if the ATR or the ADR is typically about 300 to 400 points, we'll say, and then we have a day where it's like a 600 or 700 point candle or an 800 point candle, then yes, we will expand past the max. But again, we're basing this off of statistics, we're basing it off of averages, and when you're basing it off of that, there are outliers to the data, and sometimes price does expand past the max, but it's not very often. Now, when you use this indicator though, context is a non-negotiable. This is not like a trade signal. You're not going to just like watch price enter a zone and then just blindly take a trade like a reversal if it enters a zone. That's not the intention of this indicator. That's not what I was intending it to be used for. So you should not be using it that way. It requires context, it requires directional bias, and that directional bias has to come from things like higher time frame market structure and just understanding the market environment. And the zones are to be used as location and exhaustion areas that we would be potentially watching for. These are not entries. Even though you might see the zones and they look like, oh, it's going to bounce from this zone or whatever, it's just supposed to be used as a confluence. So for example, let's say on a day like this where your bias is short, okay? New York opens, your bias is short. That doesn't necessarily mean you should be buying every single zone. You're short. Your bias is short. Why are you going to be buying against your bias just because it hit a zone? That doesn't make any sense. And that's not how this is supposed to be used. So you don't have to trade the price action based off of this indicator, and you shouldn't be trading price action based off of this indicator just because price touched a zone. So what is this indicator and what is it not? This is really important. This indicator is a volatility-based location framework that we can use basically as a confluence tool, as long as we're using context with it. It's just a way to quantify Asia relative expansion in a statistically meaningful matter, basically. What it's not is it's not a signal generator or a prediction tool, and it's not a replacement for execution skill. Don't get this indicator and then just start blindly taking trades because it's in the zone. That's not how it's really supposed to work. That's not why I made the indicator, and that's not even how I use it anyways. So I'm going to go to the charts and we're going to take a look at how it should actually be used and how it should not be used, basically. All right, so here we are on the charts. We have our indicator here, indicator here, indicator here. The way you should be thinking about this is a daily candle. This is a daily candle, and this is a daily candle. So within these daily candles, we have Asia, London, and New York. Asia, London, and New York. Asia, London, and New York. So Asia is going to basically be the blue box, London is the red box, and then we have the gray box as New York. In this daily candle that we have, we're trying to basically determine how far away above and below Asia session is price likely going to move before turning around and returning to Asia session. And so the idea is that typically what happens, and it doesn't happen every day, but typically what happens is if price deviates away from Asia session,
sometime throughout the day, it is likely, or oftentimes it does happen, where we return back to Asia's range, whether we come back to the highs, the lows, or we come back to the equilibrium or one of the quarters. So the idea is that first, before we even use this indicator like at all, we have to determine what our bias is for the day. So if on a daily bias we wake up on this day here, if on a daily bias we wake up on this day here and we think that price is going to basically continue higher, then we're not going to be looking at these areas here or this area here or this area here to try and take a sell. Okay, now if we thought, okay, here's Asia session, here's London lows and Asia lows haven't been taken out, we're at least coming and taking out London lows when New York opens up. If our bias is short, then this is where we're going to potentially use these areas, if that makes sense. And if we are short, if our bias is short, then if price comes down into this area, or this area, we're not going to be taking a long. Why? Because that's going against our daily bias. Why the fuck would we take a long position just because a box is here if our bias is short? You just wouldn't do that. So what happens on this day, right? Well, Asia session gets created. We have the high and the low. Price deviates away above Asia into level 1, comes down a little bit, but then continues into the AVR minus. Now price kind of gets a little bit exhausted at AVR minus. It doesn't want to continue higher yet, but then we have New York open. When New York opens, we push through here and then we start to kind of stall in this area. So the way that I would be using this is if I wanted to see us go lower and I thought that this move going up was basically bullshit, then what I'm going to be looking for is, now that we are in this area, I'm going to be using my other parts of my strategy, such as order flow, or if we have levels here to the left, or whatever it may be, to determine whether or not I should actually be taking a trade in this area. But I'm not just going to blindly enter as price gets into here. There's always the chance that we may just like stall here for a bit and then push higher into this zone, right? And then again, I'd be looking in this area to see what price is actually going to do. Now, in this case, we did expand into the AVR, price stalled out, we turned around and we came back to Asia's range. We took London lows. At that point, I would basically be done trading. Now, what happened on this day? Well, Asia got created. We have the high, we have the low, we have the EQ and the levels in the middle. The first thing that happens is London session opens up. We end up attacking Asia lows and we go right into level 1. Now, level 1, we bounce up. We kind of mess around. New York opens, we come down. We stay within AVR minus. We stay within AVR minus. We bounce back up and we basically consolidate. We stay in between these levels. Now, if we ever have a day where we basically consolidate, then on those days, it is likely that we stay within AVR minus to AVR minus. Let's say the next day opens up, and here we are with this day. Asia session opens up, it creates its range. We now have the high, we now have the low. Well, in this scenario here, let's say that our daily bias was based off of higher time frames. We believe price should be going higher. So what are we going to be looking for? Well, we're going to be watching these lows. We're going to see if price wants to come out, sweep the lows, and then start to head higher. Okay, so let's say if that was going to be our bias on the day, we wanted to see previous daily lows get taken out, and then we wanted to look for a rejection or a bounce to take us higher towards a higher time frame draw on liquidity if it was sitting somewhere up here. And that's where we were looking at and what was in our head when we're looking at higher time frame structure. So as London session opens up, it pushes down past level 1, it pushes past AVR minus, and it comes into AVR. It begins to consolidate, it doesn't get past AVR, and it turns around. Now, it comes back to Asia session before New York open. New York then opens up, and we begin to push. Now, in a situation like this, if our bias on the day was to go long, and our bias on the day was that price was targeting some type of higher time frame draw up here, then just because price is pushing into level 1 to the upside or AVR to the upside or AVR plus to the upside, it doesn't mean that we're going to sell there. Why? Because why would we be selling against what we believe is to be happening? If we think there's a draw up here and we think price on a higher time frame is coming higher after a sweep of liquidity, why are we going to short it? We wouldn't. Now, what you can do, though, because these are still statistical averages on how far away we might actually expand past Asia highs, we can be watching these areas for the move to the upside to basically fizzle out or get exhausted. So as we push higher, we push through level 1 with a lot of pressure to the upside. We come into AVR, there's really still pressure going to the upside. Now, AVR here, this AVR, not AVR minus, but the normal AVR, we see price kind of slow down a little bit. It is lunch, but eventually it pushes above it. So the next area that I'm looking at is going to be AVR plus. Now, AVR plus gets hit. We have price up here. This doesn't mean I'm going to take a short, but it means that this is statistically a meaningful location in terms of an expansion move where it may get exhausted. And we are at the end of the day here towards the last hour of the market. So this may be a good area to take profit if that makes sense. That's kind of how I use this indicator. I'm using it just as confluence for reference of location on how far away below or above Asia session are we typically going to deviate away before potentially turning around. I do not make trades just because it touches a zone. I do not make trades because it touches that zone or that zone. I just understand where we are in relation to Asia session. I understand the location, and then I understand the higher time frame on where we should actually be moving, in my opinion, so that I can use this as context to build trade ideas. And that's how this was intended to be used. So if you're going to use it, you need to use it with context. You need to use it with a little bit of discretion. This is not built for trade signals. Now, if you do use it the correct way and you understand that this is basically just a helper to understand location, then it can be pretty powerful. I think so. I think this is a great indicator for me, and I use it all the time. I've been using it every day, and it's really helped me out with my trading. Now, this is a private indicator. I'm not selling it to you guys. I'm not trying to sell it. You can get this indicator for free. I'm going to give you this indicator for free. You can just check the link in the description, and then you can claim access to it. You do need to be a part of our community though, but guess what? The community is also free. This is just something I'm providing to our Discord community as something that is going to potentially help out. And if you find it useful and if you figure out a good way to use it, great. If you have feedback or things that you think should be changed on it, let me know. I'll hear you out. And then that's basically it. The last thing here is just the table up here. This is just keeping track. So it's telling you what the ATR is using. It's using an ATR of 20. It's telling you what the up projection and down projection is. The only thing that you should be changing in this indicator at all when it comes to the settings, by the way, is the time zone and the ATR length, and then just the way that it looks. That is it. If market conditions changed just recently, something happened, tariffs came out, whatever, then yeah, we can lower the ATR length so that we can basically have zones that are more relevant to recent price action, because we're going ATR off of a daily candle. So if we're doing a length of 20, it's looking at the past 20 candles basically. So 20 days is a lot of time. A lot of things can happen in 20 days. If something happened 5 days ago, and we want more recent zones, then we can lower this. My recommendation to you is to keep this at 20. I think it's a good idea to keep it at 20. I've been testing it on 20. It's been working on 20. It's been working as intended on a 20 value. So just keep it there. And if you want access to this indicator, check the link in the description. This is free. Gamma exposure or GEX levels are one of the most important context layers in my stack when it comes to trading futures every single day. And I've had some people ask me how I use gamma, how I use these GEX levels when it comes to trading futures. And so that's the purpose of this video today. I'm going to talk about what it is, how I use it, and how you can actually understand what it is that we're looking at and why does it actually matter. Gamma exposure and GEX, it's not necessarily a crystal ball, okay? The levels that are printed are not necessarily places where you're just looking for bounces or rejections off of them. But it is a powerful tool in the sense that it can set up proper expectations for the day and potentially adjust the way that we head into the morning and we go into the session looking for trades. So in this video, we're going to just be going over what it is and how dealer hedging shapes compression or expansion and key intraday levels that we should be watching for, but it's not replacing structure or order flow or location or confirmation. It's just a context layer for NQ or NASDAQ futures or ES futures, where we understand the options driven positioning of market makers and dealers. So first of all, let's talk about why we should even care about gamma, why we should even consider it. Now, when a lot of traders trade futures, they're never really considering options or the options book. But that is a blind spot, not because options predict price, but because dealer hedging can matter around certain concentrations. So if you treat the listed options complex as someone else's game, you're essentially flying blind on one of the forces that routinely shapes behavior around dense strikes. So when large options interest clusters near a spot, market makers may hedge in the underlying and related products, being futures. So for NASDAQ related risk, that can show up in behavior you read on NQ futures or MNQ futures, even when the flow originated in listed options, or let's just say QQQ or NDX. So we have two ways that we can watch the same session when we're trading futures. We can look at futures only, you're looking at candles, structure only, or we can also add options context to it. So we're looking at the same tape and basically a dealer strike map. So we're using it in terms of context for added confluence to understand what's actually happening in the broader market. Now, gamma is context. It's not a trade signal. It does not replace the rest of the system that you're trading. It just helps classify the environment and know where responses could be likely. So when I take a look at gamma in the morning, I use gamma to ask very simple questions, right? Is today a day where two-way chop and pinning around a strike are more plausible, or where expansion and cleaner directional trade is more plausible? Then, once I understand that, I still need to confirm it with structure and order flow and the rest of my system. So let's talk about what gamma actually is. I'm going to try and put it in the most plain English version. And just so you guys know, when we go over some of this information, once you start understanding options, right, if you don't already understand it, it does go pretty far into depth. It's not only about gamma, it's also about the different Greeks as well, such as charm or Vanna or these different things. But for this video, we're going to try and keep it as basic as possible. I'm making this video under the assumption that you're a futures trader and you don't really understand options. And so we're not going to go into a full options full guide, okay? We're just going to talk about gamma and the basics of it and what you may need to know in order to try and use gamma data or GEX levels in your intraday trading for futures. Technically, gamma is the rate of change of delta. It's how fast an option sensitivity to the underlying moves as price moves. So in trader language, this is basically the closer price gets to a meaningful near the money options concentrations, especially where short dated exposure is heavy, the more dealer hedging adjustments can matter. So dense open interest by itself is not gamma. You care where delta sensitivity is actually relevant. And you're not trying to necessarily like pass a quant exam. You're just tracking where the machinery of hedging is more likely to engage. We don't necessarily need to understand all of the Greeks as of right now, or that's not the purpose of this video. We just need to think about how might hedging interact with price as we approach or leave those areas. So how does hedging actually work and why does it matter for futures? Well, we have to think about it like this. when a customer on the stock exchange goes to buy or sell options, someone needs to take the other side. The market needs to be liquid. Now, market makers will warehouse that risk and hedge so that their book stays within limits. The purpose of market makers or dealers is they're trying to stay directionally neutral. They're not in the game necessarily of predicting direction. So they need to stay directionally neutral. And how do they do that? Well, they do that by hedging. And when they do it by hedging, then they typically will hedge in the underlying assets, such as the futures market being one of them, but there's more of them. So hedging can use the underlying cash index components, ETFs, and futures, among other tools, and futures being only one key avenue, right? Especially relevant if we're looking at QQQ or NDX and then we're trading NQ. So the idea of this is like a very simplified hedging flow is a customer or somebody on the option market buys a call, okay? The dealer or the market maker takes the other side of that position. And now they have directional exposure that they need to manage because they're not in the game of being directionally exposed to the market. So what do? Well, they hedge in the underlying. They hedge in futures. Dealers don't all hedge the same way at the same time. Net positioning is an aggregate story, so we have to treat it as probabilistic pressure, not necessarily a guaranteed path. So when it comes to gamma or GEX, there are two main environments. We have positive gamma and we have negative gamma. Now this matters because it changes how hedging tends to interact with movement on average, not every tick, okay? We use it to classify what kind of day that we're more likely to be in, not to necessarily cherry pick an exact trade from a Greek label. Now, positive gamma often is where hedging can dampen moves. Think about it as suppressing momentum in a way, because dealers may buy dips or they sell rips in a way that absorbs volatility and price can feel pinned and we can have mean reverting tendencies or even chop around strong strikes. Now, that doesn't mean that trends can't occur. They can still occur. Nothing is necessarily forbidden, but it's just more likely due to the way that dealers are hedging against price movement. We're leaning more towards compression or rotation rather than faster expansion. Now, in a negative gamma environment, often what happens is hedging can actually amplify moves and the adjustments may chase direction. So expansions in this scenario can feel cleaner or more unstable where ranges can break with less stickiness. So if we are in positive gamma environments, then oftentimes dealers are going to be hedging against price movement. So we may see rotational behavior or compression. And in negative gamma environments, that hedging behavior can add to the impulse moves. It can make the moves faster. It can make expansion more likely. Now, we use it as expectations or how we can potentially set the expectations for the day or the session for the environment that we're actually in. It's not necessarily to predict every single candle. So then what is compression versus expansion environments? Well, intraday, I care less about labeling the perfect regime and more about the session that I'm likely going to be navigating. So the way that I think about it is in compression, we have a tighter range, we have two-way trade, there's more chop, there's rotation, and it's balanced. And in expansion, this is where we have clear directional travel, where we have trends or the impulse tends to actually move and be more usable. So when we're looking at gamma and we're looking at the environment that we're in, we're using it to inform us what we potentially need to prepare for, but entries still have to come from our process. The way that I use gamma is I'm using it as a context layer in my full stack of my system, and it typically comes at the beginning of the day. Understanding what environment we're in, understanding the structure of the dealer positioning on what is friendly. Are we more leaning towards an expansion day, or is the market structured in a way that's more friendly or favorable towards expansion, or is it more favorable towards compression? So gamma just helps me frame whether I should expect more range behavior and mean reversion around certain levels or key areas, or if we're going to have a session with a greater potential for directional expansion, but it doesn't tell me which specific setup to run. It just sets the day class that I'm trying to prepare for. The actual trade that we're taking is not solely based off of a gamma level or a positive node or negative node on a gamma profile. The actual trade needs location, response, and in my system, order flow confirmation. Now, I do want to talk about dead gamma versus active gamma. Now, this isn't, by the way, like professional options vocabulary, but I do need to talk about this because a level on a chart or a gamma level is not automatically a live wire. Dead gamma is a strike that is on the board. We see it, but it's not backed by meaningful interest or session relevance, and price can drift through these levels with little participation. So if we see thin open interest or volume at that node, we have to take that into account. Now, active gamma is a strike that we treat as live when we're looking at these levels because it could be a meaningful gamma node that has real interest at that strike on the table. So we see volume there, we see open interest, or however the platform actually shows it. And then we're watching for a potential reaction or two-way trade or decision as price is beginning to interact with this level. Not only after a clean reject or absorption or stall. So those behaviors are examples of confirmation, not the full definition of what it means to be active. So this is where many gamma failed me stories come from. You're chasing a printed line with no size behind it, or you're mistaking active for already proved itself instead of thinking in terms of this is worth monitoring closely. So when we're looking at the gamma table, which we're going to go over later, when you're looking at it and then you identify a node with interest together, we take that into account. A strike with a gamma tag but dead volume can still behave like noise, and a node with real size is usually what deserves your attention first. And the map or the GEX table narrows where to look, but live reading, once we actually get to those areas, is telling us what the auction is actually doing there. Now, there are some key levels that we look at. It's not the only ones that we look at, but they are the key levels that we need to look at when considering gamma or GEX. The labels that you may see might vary by the tool that you're using or the platform that you're using. These are the ideas that I actually use. Now, they always come with context, and you can never just use these as an automatic support or resistance. Now, what we see on a GEX chart or a gamma table is we will see typically a call wall, or some places call it a call resistance. And what this is a major upside call reference. Now, we also have the gamma flip or the HVL, depending on whatever platform you're using and what they like to call it. Now, this is basically where we are shifting from positive to negative territory in terms of gamma. And it's where regime or behavior may actually shift. And then to the downside, we have put wall or put support, depending on what platform you're using. And this is a major downside put reference. Now, the labels may change, but this is the logic to it. A call wall is often a major upside options concentration. It may act as a magnet or friction for continuation, or a place where upside costs more in hedging terms. And we watch in this area for failed continuation versus acceptance through this level. Now, a put wall, it may attract tests or dip flows or hedging activity there, but again, response confirms. We're not just blindly taking trades or trying to take a bounce off of a label that's called a call resistance or a put support or a call wall or a put wall. And then the gamma flip or the high volume line or the HVL, it's a line where the volatility regime may shift and behavior can change character. For example, from stickier to more unstable, or hedging against the flow with the flow, or vice versa. And we treat it as a probable regime boundary. It's not a single switch that decides the day alone. And so we use these walls as reference zones. The market can punch through, it can backtest, or it can ignore them if other forces dominate. And your job is to trade what happens, not using them as a crystal ball or a fairy tale of a level. And so we look at them in terms of decision zones versus reaction zones. Reaction versus decision is not a pair of predefined zone types you stamp on the chart. It's behavior that we observe as price begins to actually interact with these levels. So a clean, fast interaction versus an auction that has to work that area before we actually resolve. You can't necessarily know in advance whether the next test will be a reaction style or decision style. How price trades the level in real time, participation, pace, follow through, that is what actually sorts it. Now, execution stays order flow and footprint first in my system. This frame only tells me what kind of read we may be managing. Now, there are things that can stack or context that can actually stack at a level. Price side context and option side loading both matter, and the more that overlap, the higher odds of auction style work. It's still not a guarantee though. A stacked level can still resolve as a clean reaction if the tape is going to allow for it. So the platform that you're using, it may have several derivative metrics that are lining up at one strike or zone. So for example, you may see a call wall that also has the highest absolute gamma, or the heaviest call open interest, or the heaviest put volume, or the largest net put or call flow. And the words or the labels may vary by the vendor that you're using or the platform that you're using, but when those stack together, they become stacked levels, and that is heavier option side context. And it raises the likelihood of decision style behavior the same way as the diagram. It doesn't dictate the outcome. We still have to confirm it with order flow. Now, reaction zones or reaction behaviors is where we're looking at clean response at the test, a quick rejection, straightforward continuation, or acceptance without the market needing a long auction to decide. The read is often faster, and you still confirm it with order flow. A decision zone is where we have decision behavior in auction style work, where we may have two-way trade, chop, multiple tests, absorption before the market commits to continuation or failure at that level, and you recognize it while it unfolds, not by declaring the level necessarily in advance. So we keep a simple mental model when we start approaching these levels, right? We are looking at reaction, it's lighter, faster read, or decision, it's stacked and there's slower resolution. But then we're always looking at what the outcome is and what price is actually doing once it gets to this level. Now, when gamma, structure, and liquidity overlap, the odds of decision style auction behavior go up. They do not go to certainty. So we trade the response that we actually get, not necessarily the stack that you hoped for. So then how do I actually use gamma in my trading? Before we go look at an actual gamma table or gamma levels on the chart and how I would read that, let's talk about how I actually use it. Now, I use gamma as an environmental filter and a location map. So it does not trigger entries for me. Just because we touch into a gamma level, it does not trigger an entry, but it narrows where the auction may matter and what regime I'm potentially preparing for. So the first thing that I do is I classify the session. Are we in positive environment? Are we in a negative environment? And do we have more compression or pinning risk, or do we have more expansion potential? And then I'm marking where dealer dynamics are more likely to matter, at the walls, at the flip lines, or dense strikes. And then we frame behavior. So are we looking at mean reversion tendencies or breakout tendencies? And what is more likely probabilistically? And then we decide where to pay attention. So I'm not flat-footed at obvious interaction zones. So the footprint and the tape confirm or veto that map. And if gamma says one thing and order flow says another, well, then order flow wins. I don't argue with the tape to try and save a level or a line on the chart. Execution stays the same. Location and response first. Gamma tells me what response is more likely to count. So gamma is going to suggest, but order flow in my system always is the one that decides. So we look at the dealer map, we see price at location, then we look at footprint. In my stack, gamma sits above execution and confirmation. It's context. So the way that I typically view the market in the morning is I'm first looking at higher time frame structure. I'm building my bias, I'm building my roadmap, and I'm looking at session context and location. And then I'm looking at gamma. I'm understanding the environment that we're in. I'm using it as context. And then only as we approach levels and areas where I was already looking to sit up in my chair and start paying attention to footprint, do I start looking at order flow and footprint confirmation. Order flow is the final confirmation layer in my system. Gamma tells me where the conversation is more likely to get interesting, where I should start paying attention more. The tape tells me whether the market agrees. Now, there are a lot of common mistakes that actually happen when people are using gamma, and one of the biggest ones that I see is that a lot of traders like to trade gamma levels like automatic support or resistance, but that's not necessarily the way that we should be viewing this. And you can't necessarily be treating every strike cluster equally without a session read. And then you have to understand dead prints, because if you're just looking at big gamma nodes and we just run right through it, well, the auction never engaged there, and you need to take that into account. And you can't have gamma override the rest of your system, override price action, location, and footprint. So the bottom line to this is that the way that I use gamma is I use it as a lens. When the lens and the tape disagree, then I trade the tape. But we're using gamma as context. And what am I likely to be preparing for the morning heading into a New York session for regular trading hours? So I'm going to show you guys what I use. What I use is a platform called Tanuki Trade. But before we do that, I do just want to mention that gamma exposure helps futures traders understand where dealer hedging may matter and whether the day is more likely to compress or expand. But it only works as a context layer alongside the rest of the stuff. Structure, session location, and order flow, at least for my system. And this deck is built to match that reality. Practical, probabilistic, and subordinate to how price actually trades. So here we are on Tanuki Trade. Now, Tanuki Trade, the way that I look at this is I'm looking at it on two visual representations. The first one is the table, or the Gex Live table, and this is showing us the profile of where positive gamma is sitting, where negative gamma is sitting, and there are labels here that are showing us the absolute Gex, the net volume per level, and these are important to note. And then you're also seeing, when we zoom in, that we have C1, which is the call wall, P1, which is the put wall, and then there's the HVL, or the gamma flip level. Now, why is that the gamma flip level? Because we're going from positive environment to negative environment, right? And so this is where that's technically happening. Now, the other view that I look at is I look at it on the actual chart. Now, gamma is changing throughout the day. Dealer positioning is changing throughout the day. So it's hard for me to show this to you without having some type of back testing. But the good thing is that in the Discord, I send out basically like the daily outlooks for gamma, and I'm about to show it to you, and I'm going to explain the reasoning behind why I'm sending these things and how I'm actually reading it. Now, before I do that, I just want to explain something, okay? So I have this pulled up throughout the day, and I'm watching these levels, and you can see when levels have stacked confluences on them. So if we have C2, which is the second biggest call side gamma wall, and we also have the most absolute Gex here, the highest call open interest, the highest put volume, and the highest positive net deck strike, well, this becomes a stacked level. Now, with Tanuki Trade, you can actually click on these and it'll read this to you on the side. Now, it's hard for you guys to kind of see this right now, but basically what this is saying is that there's confluence here at this level. 5 levels are converging, and so this strike is reflecting heavy exposure concentration, and it may function as a reaction zone within the current option structure, and it's showing us what we have here. And this is important, and I think this is a great way to view these levels, and this is why I love this platform so much and why I pay for it, because it makes it easy. It makes it easy for me, right? So let me go and show you guys how I'm actually viewing this on the day. Now, let's take yesterday or Friday as an example. Now, this is market open, okay? So, what did we do during market open? We compressed. Now, if you didn't know what was happening and what the environment that we were potentially in, you could have made the assumption that we were going to make an expansion this day, that we could have ran up to maybe a 4-hour draw to the upside, right? Maybe this was your draw for the day, or maybe you wanted to see us come down and rebalance this area or even target these lows. And once market opens and we start pinning back and forth, you're wondering why. Like, why are we doing this and not actually making a move? Why are we going back and forth? Well, let me show you something, and let me show you how I approached this day and how I was actually anticipating this type of behavior before the market ever even opened. And if you can understand that, then you can frame your decisions during the day ahead of time to understand what is more likely and what is less likely to actually happen. So in the outlook for Friday, this is what I said for QQQ and NQ. I said we're currently trading in a positive gamma environment. This is where we were opening up for the day. Here we are in a positive gamma environment. Now we have the gamma flip level here, we have the put wall down here, and we have the call wall up here. Now the call wall up here is stacked, meaning that we have multiple confluences here. We have the net call open interest, we have call open interest, we have absolute GEX 2, and it's stacked here at the call wall, or where you have the largest positive gamma node. Now the idea is that my baseline expectation for Friday morning, now I understand it's not a guarantee, but the baseline expectation for Friday morning was that we were either going to see, that it was likely that we were going to see compression or controlled price reaction rather than a clean expansion for the morning. Now I did note that price is pushing higher into a stacked decision zone, right? That's that 24,450 area, or the call wall. Now, this area is just where I'm going to be watching, right? I'm watching this area to see if we're going to have acceptance past it or above it, or if we're going to have absorption there. Now, if buyers start pushing into this area and they don't have any type of result for their effort, then we can see a potential rejection. If we end up actually getting acceptance above it, then that opens the door for delayed expansion. So let's go and mark out that level on the chart, 25,450, right? So here's where that level actually was on the chart for the morning. Now, it wasn't the only level, because we also had another level. We had the second call wall, which actually adjusted later to being the call wall as the day progressed, because dealer positioning is changing throughout the day. And where is that sitting? Well, it's sitting right here at 25,360. So let's go mark that out. So as the day began to progress, okay, we had CPI on Friday. We push up, we come back down, we begin to compress towards market open. Now, am I surprised that we are compressing in a positive gamma environment? No, that was the baseline expectation for this day. So I'm watching this level as it later changes to becoming the call wall, and I understand that being in a positive environment, that dealers are hedging against price movement. Every time price moves up, dealers are selling. Every time price moves down, dealers are buying, and it's causing this suppression for momentum and volatility. And I understand that we're in that environment. So understanding that I'm in that environment, does that necessarily mean that I'm going to just be taking bounces off of this level? No. Now, if you did, you can make the argument that you would have made some good trades, right? Because this level existed here. You could have taken the bounce off of it here, the bounce off of it here. But that's not necessarily how I use these levels. I just understand that if we are in a situation like this and the environment is telling me that we're likely to compress or rotate for this day, then I am going to be less likely to try and take breakout trades. I'm going to be more suspicious of false moves, of false breakouts. And that idea is coming from understanding the environment. And that's why it's being used as a context layer in my system. And so I can go into the day today with the idea that we have the baseline expectation before price ever started doing this. before we ever started compressing like this. You probably had a lot of traders this day that were trading in trying to take breakouts. They saw effort, they try to go long here, maybe they try to go short here, maybe they tried to go long here. And they're trying to trade the breakout of this compression. But if you were using gamma and understanding the environment that we were in, and understanding that we weren't really in a friendly environment for breakouts or expansion in the first place, then you can filter those subpar decisions out of your trading day. I understood that we're in this type of environment. I understood that because of that environment, well, we need to be careful about taking breakouts, and rather we may lean more towards trades that we can have rotational behavior. And so what was the trade that I actually took on Friday? It wasn't a breakout. It wasn't this breakout. It wasn't this breakout attempt. Once we popped up above this area, and I was looking to see whether or not we were going to accept prices higher and then continue our way up here. And the first thing that happened after we got above this area is we slammed back down. Well, what is that telling me? When I'm watching the footprint, what is that telling me? It's telling me that we failed to accept higher prices above this level. And knowing that we're in a positive gamma environment and that we are likely to have mean reversion behavior, and that's the baseline expectation, not a guarantee, but the baseline expectation, well, then I go short. Why? Because that's the environment that we're in. It's likely that we're going to rotate. So instead of taking the long and trying to chase a breakout in an environment that's not friendly towards breakouts in the first place, we go for the mean reversion. We go for the rotation. We go for the rejection or the fake breakout and the slam back down into this area. And so I took short here after I saw this candle come down, and I got out pretty quickly. Now, why did I get out quickly? Why didn't I hold this trade and take it all the way down here? Well, because I understand that if we are in a compression environment, we're in a positive gamma environment, that I'm more inclined to take profits quicker. I'm more inclined to be prepared to trail my stop. Now, we can run. Now, we made a pretty good move, right? We made a pretty good move. We went all the way down for like 150 points. I didn't catch the whole thing. I'm sure a lot of people did. But the reason why I took profits quickly is because when we're in this type of environment, I'm more inclined to take profits quickly if I know that dealers are hedging against price movement. If we're in a negative gamma environment where dealers are hedging with that movement, then I may be more inclined to actually hold that trade, let it breathe, and let it run, just because of the environment being structured in a way that's more favorable towards expansion, so you can let those run. Now, let me show you an example of negative gamma. Now, I can't go back on Tanuki trade, but what I can do is I can show you an environment that we were actually in. So let's take this day, for example, okay? On this day, if we're looking at QQQ, this is where price was opening, this yellow dotted line. Now, what do we notice about this area? Well, we notice that we are in a negative gamma environment. So heading into the day, I understand that we are in a negative gamma environment, and this is shifting my expectation towards expansion and directional movement rather than just a chop. And so when I'm looking at this day, well, I'm more inclined to look for an expansion. Now, just because we're in a negative gamma environment, I do not want you guys to think just like, oh, go short, or positive gamma because it's green, go long. That's not how we view this. I just understand that being in a negative gamma environment, it's more favorable or friendly towards an expansion. So what actually happens this day, right? What day is this? This is April 7th. Now, this is what I wanted price to do. I wanted price to pop up and then expand down and have that expansion happen rather quickly, because we have that hedging with price movement, which could accelerate the move or the impulse. So let's go back to April 7th and let's take a look at what actually happened this day. So this is the day. And what do we see that we do? Well, we open up. This is the market open. We push up into this area that I wanted us to push up into. Let me show it to you side by side, okay? We push up into the area that I was looking for us to push up into. This just had to do with the rest of my framework, and we have that move down. Now, when we have this move down, I'm more likely to hold this type of trade towards the targets. Now, where were the targets for this day? Well, it was here. This was the ultimate target for the day. And I understand that we're in an environment that is allowing us to potentially have that baseline expectation of an expansion and a cleaner directional move. And so what do we get in this scenario? We're in a negative gamma environment. We have targets to the downside. We're in an environment where dealers are hedging with the move, so we can expect expansion rather than chop. And so when we see this trade, we can take it with momentum. We have speed coming down here. As we're making our way down here, this is happening rather quickly. We drop basically 200 points in 15 minutes. Okay, so the takeaway from this, because people always ask me how I'm using gamma, and a lot of traders are looking at put walls and call walls just as automatic rejection zones. But that's not how I'm actually treating these. I'm just using it as an environment filter to understand what's more likely for the day. Are we going to compress? Are we going to expand? And it's not a guarantee, but it's setting the baseline expectation. There are a lot of gamma platforms and things that you can use out there on the internet. I chose to use this one. Why? Because I love the interface of it. I think it's super useful. I love to see this information and see where the stack levels are, and it makes it easy for me. Now, there are other platforms, but this is just personally the one that I use. You can go and do your own research. You can use the ones that you want to use. But if you do want to use Tanuki Trade, then click the link in the description below. Use code NEVERFLAT, and then you can get a free trial and you can test it out and see how it works for you in your trading. Just don't view this as automatic levels where you're just going to take rejections just blindly. That's not really how you should be using this. Although it may work that way sometimes, that's not really how you should be viewing this. We should just be using this mainly to understand what type of environment that we're in, understand key levels when it comes to options data, and how dealers may actually be behaving once price is moving around at market open, regular trading hours, and what that type of behavior might be. Is it against price? Is it with price? And what is that allowing price to actually do? And then we use our system or whatever strategy you trade to actually make normal decisions. But we're using this as an environmental filter and a location map. Okay, so this is just a basic overview. I know kind of went into depth, but this is a basic overview of gamma and using it for futures trading. Now, it goes way deeper than this because you then have to take into account the other Greeks. If we're talking about options data and options, you can't just only look at gamma at the end of the day. There's also things like that influence that, such as charm or Vanna or the different Greeks. Now, that's not the purpose of this video, but my point is that it doesn't stop here. This is just a brief overview of how I'm using gamma in my trading. So now that we've talked a little bit about location and context before it actually comes to order flow, I do want to start talking about some order flow concepts and how we can actually read footprint charts and maybe some common mistakes that new traders who are trying to learn order flow may actually make when they're beginning their journey in terms of reading order flow or using order flow style charts. And the first thing that I want to talk about is delta, because it's probably one of the most misunderstood order flow concepts by beginners. In the market, aggression and effectiveness are not the same thing. Delta in order flow measures aggression, and price movement is going to measure effectiveness. And if you don't understand the difference, then delta is going to end up costing you a lot of money. Delta is one of the most, in my opinion, misunderstood tools in order flow, and it's not because it's wrong, but it's because most traders confuse aggression with control. So I'm going to try and explain delta and how I view it. Everyone talks about delta, a lot of people use it, some people use it correctly, and other people are kind of confused on what delta actually is. Now, the traders that misunderstand delta, you're gonna make mistakes making decisions based off of delta, because the most important thing that you have to understand when it comes to delta is that it's measuring aggressive participation, and participation does not necessarily equal control. In case you don't really know what delta is, if you're not familiar with it, well, delta is the difference between aggressive buyers and aggressive sellers. So if this is a footprint candle, you have volume on the bid and volume at the ask, and essentially you take the buy volume at ask and the sell volume at bid and you subtract them, and then you get a delta. It's going to be a positive number, it's going to be a negative number. What it's measuring is it's measuring who is crossing the spread and how much aggression actually occurred.
but it's not measuring who's positioned, who has inventory advantage, the higher time frame context, which is incredibly important, and then future direction. It's not measuring that. Delta is just the evidence of initiative activity. So it's not evidence of structural control. It's just showing us who is aggressive. Are buyers crossing the spread and lifting the offer? Are sellers crossing the spread and hitting the bid? And we can use that information to make decisions, but we need to understand what it is, how it's measured, and how we can actually use it. Now, there is a difference between participation and dominance, and it is time frame dependent. So aggression does not automatically equal control. Participation is who is initiating the trades, and then dominance is who is successfully moving price. And price is only going to move when aggressive flow overcomes available liquidity. However, control is time frame dependent. So short-term initiative can dominate locally, like on a lower time frame, but higher time frame liquidity can absorb and reverse. So delta is showing who is pressing and who is aggressive, but the response to that, or the price response, is going to show whether that pressure was actually effective. So you can have higher time frame liquidity that absorbs initiative dominance on a shorter term basis or a lower time frame. Now, what happens when we actually, let's say, push up with positive delta into highs? Well, it's context dependent, because let's say that here are the prior highs, okay? And we're watching delta, we're watching order flow, we're looking at the DOM, we're seeing where resting liquidity is sitting. At the highs, you might typically see breakout buyers entering into a trade, or stop orders getting triggered for traders who put their stop loss right on the other side of that high, or even momentum traders who are chasing. Now, all of this is going to produce strong positive delta. Now, just because there is strong positive delta does not mean that inherently buyers are in control and we're supposed to be going higher, because if price fails to extend meaningfully after this imbalance, then it's going to suggest that aggressive buying encountered sufficient resting supply. So let's say that we have large resting supply or large resting orders here, and buyers push into it. The orders are absorbing all of that aggression. Now, one thing to note though is that failure to extend does not necessarily guarantee a reversal. It's just showing us that aggression alone, from the buyers in this case, may not be enough. And what we need is acceptance to follow after the imbalance. And the same goes essentially for negative delta. Now, negative delta does not necessarily ensure downside continuation. So large negative delta means that sellers were aggressive. It does not mean that sellers achieved dominance. If price cannot continue lower, let's say this is the scenario and we're heading into a support, if price cannot continue lower despite the sustained selling and the large negative delta, then that is going to indicate that potentially absorption is happening by passive buyers. But again, however, absorption can actually serve two purposes. Those two purposes are position building before reversal, or inventory transfer before an actual continuation. Price response after absorption determines which one of these two it's going to be, and that's going to help us make a decision on a trade. Now, delta is here to reveal effort, but price progression following that effort is going to reveal the outcome. Now, people talk a lot about delta flips, and I use delta flips too, but some people need to understand that delta flips only matter with structure and then response, because a delta flip is really only meaningful when it occurs at a structural inflection point and it follows failed initiative pressure and it produces a measurable change in price behavior. So let's say delta flipping inside a balance or consolidation or chop, whatever you want to call it, without structural context is essentially noise. But it's important to clarify that delta or a delta flip alone is not necessarily a signal. It's just evidence of shifting aggression, and it must be validated by price response. So let's say that we are looking at price coming up into a key level. We have positive delta
as we come up. And then once we reach this key level, we now have a delta flip. You see delta go from positive and a meaningful change to a negative delta. Sellers absorbed buyer aggression, and then we essentially flip and create a sustained move down. The response shift is what we're looking for. The structure is the first thing that builds the context, but a delta flip without structure or failed initiative or response shift is like, and I'm sure depending on what time frame you're on too, if you go look at, I don't know, like if you're on a 1 minute time frame, you'll probably see delta flips all over the place. Well, I'm sure if you tried to take all of those delta flips on a 1 minute time frame as a signal, you're going to get absolutely destroyed. And the reason why is because we just need to understand that if we are going to use a delta flip as context, then we need it with structure, and we need it with failed initiative, and then the actual response shift after with a sustained move. How can price respond to an aggressive imbalance? There's three main ways. There is acceptance. Now this is where you essentially have range expansion or continuation, and there is follow through in the same direction. And this just means that the aggression is effective. So price is moving. Then there is absorption. So this is where we do have positive delta, and when we start to stall, we still have positive delta, but there's little to no range expansion, and then price can potentially stall or even rotate or reverse. And what this is essentially meaning is that aggression is present, but it's not producing any type of continuation. It's not effective. Now, the third way is a pause before continuation. So you could have a strong imbalance, large delta, and then you have a brief stall or pause, and then we continue, and the move resumes. And this just is basically meaning that aggression pauses and then regains control. One of the most important things to mention is that absorption does not automatically imply that there is going to be a reversal. It's just indicating interaction between aggressive and passive liquidity. There's a lot of times where I talk to order flow traders who maybe don't really understand absorption, and they think that anytime they identify any type of absorption going on between aggressive and passive liquidity, they're just assuming automatically like it's a reversal. Well, no, because there could be absorption and then a continuation after. It was just pause before continuation. So it's important to understand the market conditions that we're in, because they're going to define the interpretation of how we see certain things when it comes to delta. So for example, in strong initiative environments, or like let's just say a trending day, there's going to be directional conviction, thin opposing liquidity, and delta expansion is going to confirm continuation. So we're just going to continue to go. Delta continues to remain largely positive, and it's kind of one-sided trade. Now, in balance conditions, or what is consolidation or range day, or what people might call chop, you have two-sided trade. Now, in two-sided trade, usually what happens is we will have repeated rotation between highs and lows. We'll have breakouts that fail, breakdowns that fail, and then aggression is going to fade inside of the range. And you're going to have delta flips all over the place. Now, using delta in a situation like this is probably not as effective as using delta in a different type of situation or a different type of environment. And it's not that delta is inconsistent, it's just that market conditions change. And delta just needs to be interpreted relative to the environment that we're viewing it in. So there is aggression, and then there is effectiveness. And the purpose of this video is just so that if you're using delta, aggression is who crossed the spread, who's pressing. Effectiveness is whether price actually progressed or not. If there is aggressive flow that does not produce range expansion, then dominance is not confirmed. And delta is not predictive, it is contextual evidence within the auction. All it is it's just showing the effort, but price is going to show the result. And your edge, or our edge, is going to come from understanding the difference. This is a very overview of delta. The main purpose of this video is just to understand. I mean, you might hear traders who say like, oh, look at the delta, look who's in control. I mean, it's not that that's wrong, but it's just it's incomplete. So we just need to understand that participation is not control, and we can use delta. It's a great tool if you use it correctly, but we just need to understand what is measuring and what it is not measuring. So let's talk about absorption. Most traders can completely misunderstand absorption. They might see aggressive buying or selling on the footprint and immediately assume that price has to continue, but aggression alone does not move price. The real question is, did that aggression actually produce a result or produce price progression? Because sometimes the market can absorb massive buying or selling pressure and the market can barely move at all. And understanding that difference is one of the most important concepts in order flow trading, or the concept of effort versus result. So in this video, I'm going to break down what absorption actually is, how it works mechanically, and how it differs from exhaustion, because sometimes traders get them confused. But most importantly, I'm going to talk about when absorption actually matters and when it could potentially just be noise. I think it is important to make a video about absorption because it's probably the first thing that many traders actually learn when they're first getting into order flow trading. And it's important to really understand absorption and how we need to be viewing it or looking at it when we're trying to use it for information or informational value when it comes to our trading. So the first thing we need to understand is what absorption actually is and what it really means, because at the most basic level, absorption is effort without result. And that's the key concept. You have aggressive market participants coming into the market, but price fails to continue in the direction of that aggression. For example, let's say that buyers are aggressively lifting the offer and we have positive delta expanding and there's heavy trading volume, but price can't continue higher. That can suggest that passive sellers are absorbing that buying pressure. And the opposite is true for sellers hitting the bid into passive buyers. Now, one important thing, absorption itself is not some magical thing or this entry signal alone that you should just be blindly fading or taking a trade because you're witnessing it happening, because absorption does not automatically guarantee a reversal. There can be pause before continuation. All it means is that the aggressive side is no longer being rewarded for their aggression at that moment in time. But to truly understand absorption, we have to understand aggressive and passive participants. You need to understand the difference between aggressive and passive participants, because aggressive participants are traders who are using market orders. They're crossing the spread because they want to get in immediately. So when you click buy market or sell market, that aggression is what you're seeing on the footprint through delta or imbalances and executed volume. Passive participants are a little bit different. That's what you might see on like a heat map or on the DOM. They're sitting with resting limit orders and they're providing the liquidity to the market. And absorption happens when those passive participants are willing to absorb aggressive pressure without allowing price to continue meaningfully. Now, obviously, not all liquidity is visible. There can be hidden liquidity, there can be iceberg orders, and there can be things that are happening behind the scenes. But what matters to us as traders is the result, and that's the entire idea behind effort versus result. So when we're thinking about effort versus result, this is probably the most important section of this entire video, and a lot of traders focus only on effort. They look at big delta, big volume, big imbalances, but they completely ignore the result. If buyers are extremely aggressive and price explodes higher, then that's initiative continuation. There was result for that effort. But if buyers are aggressive and volume expands or delta expands and price still can't continue, that's very different information that we have to take note of, because that can be suggesting absorption when you have high effort and very low result. And this is where the idea of acceptance becomes important. Aggression alone does not move price sustainably. Price needs acceptance. The market needs to actually auction higher and higher and hold higher. If it can't, then that's information. So when we're looking at things in terms of effort versus result, we're looking at how hard someone tried and what they got for it. And we're understanding that relationship. So in the event where there is low effort but there is a high result, there could be thin liquidity sitting there. There was a book sweep or price moved easily because there was nothing in the way. Now, if we're seeing high effort, but we're also having high result, then we're looking at initiative continuation, where the aggression is actually being rewarded and pressure is being converted into directional movement. Now, when it comes to exhaustion, if we're looking at low effort and low result, where we don't have any real participation, the oxygen is simply just running out of steam or running out of fuel, then we can be witnessing exhaustion. But what we're focusing on here today is high effort with little to no result, and that is absorption. You're seeing real pressure meeting passive liquidity, and someone is actively defending the level. So if we were to be looking at continuation versus absorption, you would see aggression, you would see displacement and acceptance in a continuation. In the event of absorption, you would have that same aggression, but we would begin to stall and potentially even reject, and you would watch the pressure actually flip. Now, I do want to take some time and talk about exhaustion versus absorption, because this is another area where traders confuse them with each other constantly. Absorption and exhaustion are not the same thing. Absorption means aggression is still present, but someone on the other side is actively absorbing all of that aggression. Exhaustion is actually different. Exhaustion is when participation itself starts to actually dry up. So the move stalls because traders stop pushing, not necessarily because a passive participant is defending the level aggressively. So absorption usually involves heavy participation, heavy interaction, and effort without continuation. Exhaustion usually involves declining participation, less aggression, and the move simply ran out of fuel, kind of what we mentioned earlier. But it is important to note the difference between the two. And so when we're looking for absorption, volume is a very big thing. We need to see a lot of participation, but just no result for that participation. So we're going to take a look at the charts in a second, but I just want to talk about how absorption actually appears on the footprint. We have to look at volume, delta, and price behavior, and we have to look for all of them together. Now, what you'll typically see in terms of absorption is you'll see heavy volume at a level, aggressive imbalances into the level, and price fails to expand. The reason why I have the POC in the candles, if you've ever watched how I trade, is because I'm looking to see where the POC is in relation to the candle and the body, meaning that if the POC remains near the rejection area or high up in the wick, well, that's important information. I'm looking at strong positive or negative delta, and I'm watching for repeated attempts to actually push through a key area. And if wicks are forming at this area and we're not getting that continuation or that acceptance above the level, and if the next candle then fails to continue, then at that point, we can be witnessing absorption. We have to read the relationship between pressure and outcome. Now, this is really important. This is extremely important because absorption alone is not a trade signal. Why? Because absorption happens constantly throughout the chart. Even if you drop to like a 1 minute or whatever, if you try to trade every instance of absorption that you see, you're going to get destroyed. And a lot of the times, especially when we're chopping, you're going to see absorption happening at both ends, right? So location matters, and location determines whether that absorption holds weight in how we should be viewing it and if we should be using it to take a trade, right? We look at things like, did it happen at a prior high? Are we seeing absorption at a liquidity sweep or a higher time frame level or a session extreme or a gamma level? Or did it happen randomly in the middle of a balance? Because absorption in the middle of noise usually means nothing. It's usually just noise. But absorption at meaningful location after initiative activity expands into the level, that becomes information that's worth paying attention to. So location is extremely important when we're watching for absorption, when we're watching for effort versus result. Now, like I said, though, when it comes to absorption, it doesn't guarantee a reversal, but why can absorption actually lead to a reversal? Absorption matters because it creates trapped participants, and trapped participants can fuel the move in the opposite direction. So let's say, for example, that we have a breakout attempt. We have aggressive buyers chasing it, and passive sellers are absorbing all of that buying aggression. There's no acceptance above the level, and late buyers are now trapped. They got in at the worst time possible, And when the pressure flips lower, it may fuel the move in the opposite direction if they have to get out of their position, because what do buyers need to do to get out of a position? Well, they need to sell. And that ends up potentially fueling the move in the opposite direction. Now, just because we see absorption though, it doesn't mean that it's automatically going to be a reversal. So we need to talk about what confirmation looks like after absorption. This is where newer order flow traders really mess up, because they see absorption and then they immediately try and fade the move. But absorption itself is not the signal. Absorption is evidence. The confirmation is actually what comes after that absorption. Did the continuation fail? Did pressure actually begin to shift? And did the breakout fail to gain acceptance? We're looking at things like delta. Did delta flip? Did sellers begin stepping in more aggressively after buyers stalled? And that sequence of events matters, because absorption without confirmation can still lead to continuation. We can have pause before continuation. Strong initiative activity can still reassert itself and continue through the level. So this is why it's really important that you see absorption, sure, but you shouldn't just automatically fade it and try and take a reversal. You still need confirmation, because there are a lot of times if you're looking at absorption that you can be watching absorption happen or a stall at a level before that initiative activity re-engages and we push through that level with acceptance. So just remember, absorption can still fail. It's not some magical thing. It's just information that we're watching, and we have to wait for confirmation, because again, strong initiative activity can reassert itself and continue through the level. So the way that we think about this in terms of a decision tree, when we're watching the charts, we're watching order flow, is did price reach a meaningful location? If yes, then did aggression fail to produce a result? Did we see a lot of aggression heading into this level and we failed to actually continue with price progression? Then we need pressure to flip. If it did, then the trade idea is valid. If we see aggression failing to produce result, but we aren't seeing that pressure flip, then we have to wait, because we don't want to try and step in front of a move that can potentially continue. Just because absorption is showing up on the chart does not mean that we're going to reverse. It's so important. I can't stress it enough, because I see a lot of order flow traders who just look for absorption. Oh, I see it, reversal. You shouldn't be doing that. You really shouldn't. And location is incredibly important, because if this occurs in the middle of chop or balance with no meaningful location, the correct decision is usually just to sit out of it until we actually go a certain direction or get out of that area. Now, let's take a look at a real example on the chart, because this is where the concept usually clicks for people, right? I know that we're just going over this on this thing I created, but when we go on the charts right now, I want you to pay attention to the relationship between aggression coming into a level, the actual result that the aggression produced, and then what happened after that continuation failed. Because the important thing here is not predicting a reversal. It's recognizing when the market is no longer rewarding aggressive participation. Now, let's take a look at what this actually looks like on a real footprint chart. So here we're pushing into the highs, and you can already see aggressive buyers coming in on the way up. We have initiative buying, we have positive delta, and we have participation that's expanding into this level or into this high. Now, this is where newer order flow traders or footprint traders usually make the mistake where they see aggressive buying and they automatically assume continuation. But remember, aggression alone is not enough. Price still needs acceptance above this level if this is the level that we're watching. So look what actually happens here. We break above the level briefly and volume trades at the highs. The POC of this candle is sitting up here, meaning that there was a lot of transactions that were actually concentrated here at the highs. So this tells us that real business traded up here and real participation actually happened. But what matters is the result. Even with all of that buying aggression, price fails to continue higher. The breakout can't gain acceptance. And then look at this candle here. We have this red candle that actually has a positive delta. Now, it's only positive 15 if you can see this on the chart, but regardless, it's still a positive delta with a bearish candle. And this is an important concept, because if you only focused on delta, you'd be thinking that buyers were still in control because we have a positive delta, or it would have been positive as this candle was actually forming, right? Because if the POC is sitting up here, then if we were to go into replay mode and you're watching this candle push up, you would have seen the candle have high amounts of positive delta. We would have been stalling up here before the candle flipped bearish towards the end of the candle. The result of this aggression from buyers is telling us a different story. Buyers are still being aggressive, but they're no longer being rewarded for that aggression. And that's the key idea behind absorption. Now, after we actually stall up here and buyers are aggressively trying to push price higher and not being successful in terms of outcome, we begin to see sellers step in aggressively. You start seeing imbalances hitting the bid, and it's coming back in the opposite direction. The absorption itself wasn't necessarily the trade signal. The absorption was the evidence that the breakout was failing. The confirmation came after. We had the failed continuation, the inability to actually hold above the level, and then the pressure began to shift back lower. And that's why context matters so much. If this happened in the middle of chop and not at these highs, or if we were looking for a liquidity sweep, if we were watching the DOM and we saw levels stacked up here in terms of orders on the book, it's important to note. But if it's in the middle of the chop, I probably wouldn't care. But because it happened into the highs at meaningful location after initiative buying expanded into a level, it becomes information that's actually worth paying attention to. Now, if you were to have an entry model, which I have entry models for absorption, but if you have an entry model, then where would you be placing your stop loss? Well, you would probably be placing it on the other side of where the absorption actually occurred. And you'd be targeting whatever you're targeting, right? So we have buyers push in, buyers get absorbed, they fail to continue higher, pressure flips, we start making our way back down. Now, this is just one example. It's actually not even a perfect example. It's just from recent price action as I scrolled back to try and find an example on the chart for you guys. But the idea remains the same. The real edge in this is not spotting absorption. The edge is knowing when the absorption actually matters and where it's happening and whether the market confirmed that the aggression has actually failed. We're not using footprint to try and predict what the market's going to do. We're looking at footprint charts to reveal the interaction between aggression, liquidity, and acceptance. So effort shows the intent, but result shows the truth. And we can use the concept of aggression or effort versus result or outcome. And we can use that to potentially take trades. All right, so today I want to talk about volume profile and how I actually use it in my trading. Now, you may see that I use volume profiles over sessions or maybe even a fixed range volume profile, but I'm sure a lot of you guys see, if you're especially watching me trade every day, that I'm looking at volume profiles inside of every single candle. Every individual footprint candle on my chart has its own miniature volume profile. So I want to talk about how I actually use it in my trading, because there are really three different ways that I use volume profile. I use it inside of every individual candle. I use it for the session profile for regular trading hours. And I use it as a fixed range inside of an expansion leg or clear structure. But before we get into that, I do need to just clear up what a volume profile actually is. Now, a volume profile is a map of participation. So it shows you where volume was transacted at each price level over a defined period of time. Now, in the context of auction market theory, it helps you see where the market accepted price and where it moved too quickly to build meaningful agreement. And that is really the core idea behind volume profile in general. Now, the market spends time and volume at prices where value is accepted, and it moves quickly through prices where there was less agreement on value. And that distinction matters because it tells you where the auction slowed down and where it did not. And inside my framework, the way that I use this is volume profile lives inside location and confirmation layers. It's helping me validate where price is located actually has structural meaning. It's not just a random number on the chart. It's an area where real business was done, or an area where the market moved too quickly to really do much business at all. Now, inside of every volume profile, you're generally going to see the same 3 or 4 things. You have the point of control, or the POC. Now, this is the price or the price level with the highest traded volume inside that profile. And it's one of the strongest references to where participation concentrated. You also have value area. So that's where you see value area high and value area low. Now, this is the range within a volume profile where you're roughly going to see, 70% of volume. that was traded inside of that profile. And that gives you the accepted range for that profile, or where most of the business was being conducted. And then you have high volume nodes and you have low volume nodes. Now, a high volume node is an area of prior acceptance. This is where the market spent time doing business, and when price returns there, the market may slow down, it may rotate, or might spend time there again. It is essentially an area of agreement. And then you have low volume nodes, where this is essentially an area of thin participation. This is where the market moved quickly and didn't spend much time there doing business. And when price re-enters a low volume node, it can either move through quickly if imbalance is continuing, or it can react sharply if the move into it fails. The level itself is information, but it's not a guarantee. And that's an important distinction to make, because a lot of traders look at low volume nodes like they automatically mean continuation, but that's not how I use them. A low volume node is a candidate for movement, where what price actually does there still depends on context and confirmation. Now, the first way that I use volume profile is inside every individual candle, right? Every single candle on my screen on a footprint chart, as you can see, has a miniature volume profile inside of it. What this is letting me see is it's letting me see where volume was distributed within this single candle. Now, it may be a 5-minute, it may be a 15-minute. Sometimes I look at it on the hourly, but this is the most granular use of volume profile for me. And it's actually used majority of the time. It's used at the execution level when it's inside of these 5-minute candles. Now, I'm not using these miniature volume profiles as a standalone signal to take a trade. I'm using it to refine execution once the broader setup is already there from the rest of my framework, right? What I'm really looking for here when I'm looking at volume profiles is I'm looking at effort versus result. If I see volume trading at a level, like let's say this candle where my mouse is right now, but price is not following through, or it's not moving through it, well, this could potentially be useful information, because it could be absorption. Now, it tells me that there is aggressive participation, especially at the extremes of these candles, but it's not getting the result that it should be getting. Now, this doesn't automatically, when you see this, mean that there is a reversal coming. It just tells me that something is happening here at this level. And when I see that, then I watch the reaction, and it has to be in location, and the rest of everything else has to align, but I'm watching the reaction that follows it. And when I identify absorption, I'm looking for aggressive participation at the extremes of a candle, like in this case, with little to no result in that effort. High participation with little continuation, whether we stall or we reject. I mean, it's very different from just seeing volume and assuming something is bullish or bearish. And if the volume is not really there, then I'm less interested in calling it absorption, because at that point, it's more likely a lack of participation or exhaustion rather than true absorption. So volume is very important, and that's why it's in every single one of my candles. Now, another thing I look at inside of a footprint candle is low volume nodes. So for example, if we were looking at this candle, we have a volume profile here. It may be hard to see because it's blue on black, but here is a low volume node here, and here is a low volume node here. If this is in the way that I take trades, it usually requires 2 candles. Now it requires the confirmation candle and the entry candle. I am looking, let's just say, because I don't want to go back and like try and find some type of perfect example or whatever, but because there's low volume nodes here, let's just say we're identifying absorption that's happening, and we are getting the confirmation that we may be seeing a potential reversal. Now, after the confirmation candle closes, I am looking for the entry candle to immediately pull back into the confirmation candle. Immediately. So open up and immediately pull back. And I'm looking for it to pull back into these areas with low volume nodes. Now, if there are stacked imbalances in this area, which there aren't in this candle, but if there are stacked imbalances in this area, then it's even better. But I'm using these low volume nodes inside of the confirmation candles to refine my entry in my entry candles. But again, low volume nodes inside of a candle is not necessarily the signal. It's just where I can sometimes get cleaner execution inside of the larger setup that I'm trying to trade. Now, the second way that I use volume profiles is through session volume profiles. And I'm specifically looking at the regular trading hours or the RTH session of New York Open when I'm trading NASDAQ. I'm usually keeping it on the 1 hour chart, and I'm looking at how the day is building and forming and building value in real time. I want to know where value area high is, where value area low is, and where the POC is sitting. And I'm looking inside of this profile for the day to understand where are there low volume nodes and where are the areas where a lot of business was actually conducted, or where are the high volume nodes sitting within the broader auction for the day. This is essentially giving me a bird's eye view of where the market is accepting price during the session. If price is rotating inside of value like we were doing here for a moment, then that tells me that the market is temporarily balanced. If price is leaving value and getting accepted outside of it, that tells me that an imbalance may be developing. And it's kind of easier to show you if we're watching this actually form throughout the day. Now, as this auction was actually forming today, well, value area started up here, but because of we're watching it kind of after the fact, after it's already done, well, now after this large move, value area was distributed, and now we have the POC sitting down here rather than it being up here where it was earlier in the session. But again, just because we touch into value area high, or just because we touch into value area low, it's not a signal. Or even just the POC, like a bounce off the POC, I'm not using it as a signal. The session POC is important because it's a valid reference to understand where the most amount of business was actually conducted during the session, but I'm not using it as some like guaranteed magnet, right? In balanced conditions, price may rotate around it a lot. In trending conditions, price may ignore it completely, so I use it as reference. It's not necessarily a promise of anything. Now, the third way that I use volume profile is I'm using a fixed range volume profile. Now, how does that actually look? So let's say we go back on this side of the chart and we want to see how the auction was actually developing within a specific expansion leg. Now, let's talk about from here to here towards the end of the day. Now, what I'll do sometimes is I will go here, I will draw a volume profile from swing high to swing low and extend it. And so we get basically the same thing, but it's within a specific expansion leg or defined balanced area, or even a prior session range like London session or Asia session if I care to look at it. The reason I do this is because I am trying to isolate how volume was distributed over a specific leg or piece of structure. And usually I'm doing that over a clean expansion leg, and I want to see where participation was thick and where participation was thin, and where the POC of that move is actually sitting. And this information can be useful as we watch price pull back into this move later on. So the fixed range profile helps me frame location inside of structure. It narrows the zone, but it doesn't necessarily replace context. And that's really how I use these three methods together. The session profile sits in the broader context to understand how is the auction actually forming over the session that we're trading or the previous days. As we move into previous day regular trading hour sessions and the volume profiles that have been built previously or historically, and the fixed range profile helps me narrow location in the sense of a structural zone. And then the footprint candle, when I'm zooming in on these candles and I'm looking at the volume profile within each of these candles, it's helping me refine my execution once everything else is already in place. Now, there are a few mistakes that traders will make when it comes to using volume profiles. The first mistake is treating low volume nodes like this as like automatic entries. Just because price moved quickly through an area doesn't mean that it's necessarily going to do it again, or it doesn't mean that, we're going to just automatically bounce out of a low volume node. A low volume node should just be treated as a location candidate. That's it. A location candidate. Somewhere where we're going to pay attention. It still needs context. It still needs location and it still needs confirmation. And the second mistake is using the wrong profile for the wrong job. Just because like the session profile is not, and I don't use it for micro execution. The footprint candle itself is not used for broader auction or market context. Each profile has a time frame role, right? And that's how they work together in my stack and how I'm actually using these. And the third mistake, which I see all the time when it comes to these types of candles like this, or even just like session profiles, is that traders will like over obsess on the POC. The POC is a great reference, and don't get me wrong, I use the POC all the time, and it can matter a lot in absorption scenarios inside of these, miniature volume profiles, and it can matter a lot in a balanced condition in the broader context of the market. But let's say that during a trending environment, price may never come back to it. So if you treat it like a guaranteed target, you're going to potentially misread this. So if I had to just summarize it simply, because some people ask me like, how am I using volume profile? And I'm just trying to give a broad overview of what I'm actually looking at. Here's how I use volume profile. On the higher time frame in the session level, I'm using it for context. I want to know where value is actually sitting. I want to see where participation was being accepted and where the auction moved too quickly to actually build agreement. On the execution time frame, on these candles, I use it to read effort versus result and to refine where I want to execute once the setup is already there. Now, I may look for pullbacks into low volume nodes. I may look for pullbacks into the POC of the previous candle. And as long as it aligns with the rest of my framework, then I take the trade. That's it. Volume profile is not a signal in isolation or a signal by itself. It's just a layer inside of the broader framework that I'm actually trading. There's a lot that actually comes before I'm looking at a volume profile. There's context in terms of market structure and bias, and then understanding the environment we're in, looking at gamma, all these different things. But these volume profiles are just helping me understand where the auction accepted price, where it didn't, and where the execution could potentially be cleaner. So before the session, I'm looking at the prior sessions, POC, the value area, the low volume nodes, the high volume nodes. And during the session, I'm watching it build for this RTH session in real time. And at the execution level, I'm using these miniature volume profiles to refine the entry after context and confirmation are already in place. And that is how I use volume profile in a nutshell. I'm looking at value. I'm looking at acceptance. I'm looking at effort versus result. I'm understanding where the POC is at. I'm looking at value area, low volume nodes. I'm looking at high volume nodes. All right, so let's do a daily outlook for May 18th, 2026 on NASDAQ. So we came into discount overnight of the higher time frame range. We were able to hold discount and stay above the 29,000 area or find a little bit of support here and be able to push our way up. Now where we are currently at in terms of gammas, we're sitting right around the transitional area, so right below HVL. Higher time frame in general is still bullish, and we are watching us find a bit of support here heading into New York Open. Now, the most key decision area for me today is going to be the HVL. Now, the HVL is sitting at 29,270. Early on in the session, this is the most important level. If the buyers can push above and hold and break above the HVL and start entering our positive gamut territory, then the first real upside target becomes the call wall as well as Friday's New York session highs. In the event that we even break the call wall, then I will be expecting us to potentially have a delayed or slower grind up towards where the net call open interest, and absolute open interest is actually sitting. But for now, our eyes are set on the HVL. In the event that we do get above the HVL, I will be looking for a continuation higher towards Friday's New York session highs, as well as where the call wall is currently sitting. If buyers fail to get above the HVL and fail to reclaim this level and we begin to rotate lower, then it is likely that we continue a downside rotation towards potentially P2 or even the put wall sitting here at 28,860. The game plan for this morning is actually pretty simple. We're really just going to be watching how the auction resolves around the HVL this morning. And we're going to be looking to see whether we're going to continue back up and continue the higher time frame trend being bullish, heading our way back towards call wall, or if we're going to rotate for a further drop lower down in this negative gamma territory. It's a very clean decision day today. We're going to be watching HVL. We're going to see how the auction actually plays out, and we'll see how it goes. Right now we're retesting the HVL. I think we're seeing buyers try and reclaim the HVL, but they're failing. I'm going to go short right here. We're seeing a large trade come in. We have to hold this. We're approaching the put wall right now. This is current put wall sitting right here. So we're looking at put wall being right here. It's bouncing back and forth, but there's a very large negative gamma node right here. So if we can push down past this big trade, I'm going to be trailing my stop right below it. So now we're currently approaching the put wall. If we can begin to push lower through these orders, just like that, I am going to have to trail my stop. Stop's going to be going right above the POC of this candle. We're looking for it to continue down. So if we could break through this and break lower right now, I am going to be adding in and trailing a stop. I don't want us to pop back up. I'm trailing my stop right above these large sellers. As long as we hold below this, we should... There we go. Very large seller. We need us to continue though. We can't have us reject these orders like this. Alright, so we hit trailing stop. We couldn't get past this area. We had a lot of selling pressure step in. So right now I'm currently watching this area right here. This is where the put wall used to be today before it ended up moving back down here again. There's a lot of negative gamma here as well as some volume. So we're going to be watching to see if sellers want to defend their position. If we begin to see buyers start getting absorbed and we begin to rotate over, I am going to go short again. I'm going to go short right here. Stop loss is going to be right above these highs. And we got to be careful about this area. We're having sellers come in. We had buyers fail to push back up. We just need follow through from the sellers. If this order gets rejected, it is a pretty good sign for us to start moving lower. I'm going to have to trail stop a little bit. We had a massive amount of buyers step in here. They tried to step in here again. They failed, which is a good sign for this trade, but I do have to understand that they are present in this area, so we're going to trail stop. We're trailing stop as we're moving down. There is a chance we bounce back up hard here, so I'm moving the stop as we go. This is the most important area that we need to break right now, that sellers need to really push through hard. I'm going to trail stop even tighter. Alright. We ended up getting out of that for 50 points. I don't want to see us bounce out of this area. We had buyers step in here once. We may continue down further, but I don't want to risk it right now. Volatility is very large. We can easily just start snapping back and forth in this area. Now it may still work out and we may make our way all the way down here to P1, but this area right here is order flow wise. We had buyers step in here, sellers got absorbed in this area, so if it happened once, it could potentially happen again. So I need to trail stop pretty tightly, and I'm happy we did because we could see this moving back up relatively quickly. So at this point, we took 2 trades. It's 2 wins. We're gonna wait a moment and we're gonna see if there's anything else we can take. So the first trade was for about 50 points, I believe. The second trade was also for 50 points. So it puts us up about 100 points on the day. We're trading a live account, so we're using smaller size. But this is great volatility. There's a lot of opportunity here, and we are in negative gamma territory, so there could potentially be more moves. I mean, we're seeing good volume right now, even this late in the day, which is pretty interesting. So I am still watching this area, though. If we see buyers attempt to push up here again, we may, and they fail, we may be forming a range, which this is a large enough range that we can actually play this. It's over 100 points. So if we get a slight overextension and buyer failure, then we can try and take another short. All right, so what we're looking for is about 130. We're looking for us to come up to about 130 right now. All right, so if we begin to see buyers get absorbed, we're going to go short. All right, I'm going to go short right here. A little bit of a late entry, but we popped into 130 and we started seeing that rejection. So we're going to see if we can actually take it lower. And we're going to be targeting P1. See if we can make our push down to P1. All right, we're 25 points in profit. Stop's going to break even. as we begin to push lower back towards the bottom of this range, we are going to have to trail stop even tighter. We'll see if we can get the push here. Alright, it came back up. There's a chance we continue, but we are compressing, so I do have to be kind of careful. We went about 25 points in profit and then it snapped back. So we may call it a day there. We had us come into that 130 area we were watching for. We tried to see if we would have that push lower. We couldn't have the follow through from the sellers. We're beginning to compress a little bit right here. I don't want to see us get pinned down here and begin to chop essentially. The ATR is incredibly large. On a 5-minute, we have an 81 point ATR, which for trading my live account, it's slightly dangerous to actually trade when the ATR is that large. I have to use really small size. So I think what we're going to do is I'm going to just call it here. This idea may still work out, but it's all right. We took a short up here. We got out for about 50 points. We were trying to target P1. We took another short right here. We got out for another 50 points. We were trying to target P1. And then we were trying to go short again right here. We got hit out at break even. There is a chance that we still drop down to P1, but we're green on the day on the live account. Don't really want to mess it up at this point. We're compressing. It's better if I just kind of call it a day and come back tomorrow. But just to recap, the idea today was very simple. We hold above HVL, then we're looking for us to make our way up here to the call wall. We held below HVL, then we were looking for us to make our way towards the put wall down here. When we came below HVL, we attempted to push back up and buyers failed. So when we started rotating back over and sellers started to step in, that's where we go short. We tried to target P1. We were getting some good momentum, and then P1 then switched to this level, which we began to kind of find a little bit of support here. So when it popped back up, it hit us out at our trailing stop. When we came up into HVL again, we saw the exact same thing happen, but I didn't want to take this trade because there was a potential that we could have just done this, right? So I wanted to wait for us to break where the put wall was temporarily. And once we actually did that, we pushed down, we try and push back up, buyers failed, we pushed down again, and this is where I went short. So we tried it again right here. It may still work out, but we're compressing. It's better to call it a day. So I'll catch you guys next time I trade. We caught about 100 points today. Peace. Okay, so this morning we are currently looking at a large move that happened overnight. We are in negative gamma territory. So we dropped about 470 points from the overnight with not much structure, just a drop. We didn't see much of a pullback at all. Now, in terms of gamma, what I'm looking at here is we do have the put wall sitting here. We are in negative gamma territory, so the baseline expectations is more for faster directional moves while we are in this location, but I am paying attention to the put wall here sitting at 27,060. Now, in the event that we actually begin to accept below the put wall, I will be looking for us to fill the gap from the new day opening gap here down to potentially 26,944. We left this here from last week, and so I will be watching this to see if we actually make a move down here if we start accepting past the put wall. Now, in the event that we start moving back up, I will be looking for opportunities for us to turn back around and continue the selling pressure. Eyes are set here on what's going to happen at the put wall, whether we're going to get a full bounce off of it with true buying momentum coming back up, or if we're going to accept lower and go and fill the new day opening gap from last Friday. Because we're getting currently a bounce off of the put wall, I did enter in on a continuation long here, looking for pre-market New York to create a little bit of structure and make our way up here. So I'm trying to hit profit target right now. I'm trailing stop, and we're going to see if we can lock in profit target on this brand new eval.
Order filled.
All right, so we were able to hit profit target. We are getting that bounce off of the put wall. We're pushing up higher. Pre-market, as the new hour opens, I'm going to be looking for us to put in some sort of high or create some type of structure, and then we're going to be looking to trade the funded accounts and some of our other accounts here today. But the first trade that we took, we were watching us come down. We came into the new put wall location. We had buyers start stepping in. We started coming up. I entered in on the continuation of that for us to create structure, and we were able to hit profit target. So we're going to wait now. There is no, we sold just immediately off the open. There's no wick to the upside. We may, I mean, there's a tiny wick, but we may continue this sell off. Keep in mind, if we are going lower, eyes are set for the green box right here for the end dog to get filled, and then we're going to be moving into the hourly location. This is a very important level though. So as we begin to push back into the put wall, I'm going to be watching footprint to see if there's a potential for us to snap back up. Because also, if you were to draw out this range on a 5-minute, where we, you know, it's sitting right around here. So we're pushing into that put wall right now. What I'm actually going to do on this eval is I'm about to fade this. I'm going to put my stop at the lows. We'll see if we start snapping back up. We have this hour, or this 5 minutes about to close. I just need us to get to the top of the 5-minute from the open for us to just go test the open one time.
Order filled.
All right, so we hit profit target on that for about 84 points. Second trade, we pushed down off the open, little to no wick to the upside. We approached discount of this 5-minute leg. We tapped into basically the put wall again. So I went long. As we began to stall here for a moment, I went long, and then we got out. And the only reason why we got out, just so you know, is because profit target, right? Because if we were holding this on like a funded account, you would actually want to hold it a little bit more, because there is a potential for us to expand further up, potentially into here or even where the previous put wall was. So now I'm watching to see if we're actually going to continue up. And then in the event that we continue up, I'm going to have my eyes set on that 265 area for a potential to just watch whether or not we're going to rotate back again lower, if we're going to actually start accepting up past it and going higher. So we're pushing up. This 265 area is going to be key. We have the largest net call volume, highest call volume, highest absolute gamma, and it was the previous put wall. Our eyes are currently set on 265. All right, we're about 10 points away from previous, or this is the new put wall. It moved from down here back to up here, so this is going to be a key level to watch for. We'll be looking to see if, you know, we see any type of reason to take a short up here and then come back down, or if we're going to accept back above it. If we begin to accept it back, oh, hold on. So we just got a little bit of some sellers popping in right here. I am watching, I'm like looking up here though for a potential short, but I don't want to take it yet. I need it to be cleaner. We have sellers, you know, kind of entering in, but I don't trust it yet. And if anything, what I'll do is, if we are going to put this in as the high, then I'll be looking for us to, first of all, get past this area back to the 180, and I'll wait for another like attempt higher and then a failure, and then I'll go short. There's two potential areas I'm going to look for a short, depending on what footprint shows me. Here and here. Where we're going to be watching this area that has the 224 area and then 265 area, but we need confirmation in terms of attempt to push higher like right now, and then we need to see buyers fail and get absorbed, and if we start to rotate lower, then I'm going to take a short. All right, depending on how this closes, I might take a continuation lower. This is just an area right here where we could potentially bounce back up from.
Order filled.
All right, I'm going to go short right here. I'm anticipating for us to break past this area. We got our reaction out of the area we were looking for. It wasn't as clean as we wanted it to be. I'm just going to be putting my stop right here. I'm going to be targeting down towards the put wall again around 27,060. So we were watching 265, didn't completely get up there. We did get to that 224 level. We started respecting it, and we started seeing sellers start stepping in. So at this point, I'm trying to see if we're going to continue down back towards the put wall of where we were pre-market and where we tried to push down the first time at open. We just need a bit of selling pressure to continue this move lower. And if we do start seeing some selling pressure, then at that point I'm going to be moving my stop to break even. Alright, so we don't want to see price at this point get past 181. I'm going to tighten stop right above this 5-minute candle. So we're risking about 25 points, because right here is the POC of the last 15-minute candle. So if we're going to continue lower, I need to see it get respected and for us to continue this drop lower back towards the put wall. Alright, so we need to see some continuation. Stops now at break even. It's really important that we actually get past this large seller here. Otherwise, we don't want them to be trapped and then we spring back up. Alright, we're getting a lot of pressure right now. Stop is going to actually trail behind this 5-minute candle. So position's currently looking like this. We're about $600 in profit. We're going to see if we can get our continuation lower towards the put wall here. We just need to keep this selling pressure. If we stay below where this low volume node is in these the large seller here, then I'm actually going to trail it even harder, just right above this area. We need to be careful as we start approaching this area again where we keep seeing buyers defend it. Alright, at this point I'm going to trail even tighter, just right above the large seller here. We're getting good selling pressure. I'm actually going to start trailing a little tighter. I just don't want us to bounce off of this area hard, so.
Order filled.
Beautiful. Alright, so we were able to catch this trade. We got out at the put wall again because there is a chance that we can bounce off of it. But at that point, I think I'm actually done today. So we were able to hit profit target on this account with longs pre-market off the put wall. We were able to, at the open, have us drop back into location, take longs again off the put wall, and then on the funded account, or we were looking for the previous put wall for a potential reversal back down towards these lows for a continuation. We were watching this area too. We didn't see a clean entry until we started slipping lower outside of this compression. Then we went for a continuation and targeted down here. So in total today, 71, 85, and 104 points. So what is that? So in total, we caught 260 points today. In total is about 1,000 ticks. So honestly, that's a banger day. Makes me comfortable to stop here. So I just want to mention, if we were to go look at the daily bias that I had today, it kind of played out perfectly in terms of what we were actually looking for. We were looking for price to come up off the put wall, come into this area, and then have our continuation lower. If you've been trading and you've been losing money, or if you're switching strategies all the time, looking for the new entry model, you're trying a different method, you're buying new courses, you're looking for the right person to copy their trades, or you're trying to join a new Discord or whatever, and nothing's working, I need you to hear this. It's not the strategy in most cases, it's you. You're the reason why it's not working. And that doesn't necessarily mean you can trade any bullshit and as long as you trade it correctly, it's going to work. No, you do need an edge. But my point is just that if somebody were to have a statistically proven edge and they teach you exactly how to do it, if you don't have the right foundation, chances are you're probably going to have much different results. And I know that's not what most of you probably want to hear, but it's the truth. And it's the reason why most people who try and do this, even though there's so much information out on the internet that you can use to your advantage, that they still lose money and they still never make money. And I know it's the truth because I did it. I did it for 2 years. I lost money every day for 2 years. I blew probably, before I got a payout, I probably blew like 150 to 200 accounts, and they were like big sized accounts. So I probably spent close to like $50,000, probably more than that, of cash that I actually didn't even have, that I put on a credit card. I had no idea how I was going to pay it off. And I did all of that while thinking that the problem was I needed to find the right setup. I needed to find the right strategy or that one indicator that was just going to make everything work. It's not about that. It's not about the indicator or the strategy or whatever. Now, again, because there's going to be people watching this who go, oh, don't give me this bullshit about edge doesn't matter and it's just about psychology. No, I agree. Edge does matter. But even if you have an edge, if you can't execute it properly, then the edge doesn't mean jack shit. So the point of this video is just to explain you need to start with a proper foundation. And most people skip that. Most people just go immediately to some type of pattern preference or some type of shit that they're trying to trade that they see on the internet where some guy goes, this one setup changed my life and this one indicator gives me a 90% win rate. And then you got people who don't know anything else other than trading and they just like try and copy and paste what they see in a video and then they lose and they wonder why. They say, oh, that was a bullshit strategy. That shit doesn't work. I'm going to tell you in this video exactly why this happens. And more importantly, I'm going to tell you what you actually need to fix before the strategy or really any type of edge is actually going to work for you. Because most traders figure this out too late. And actually, some traders never figure it out at all. And they just quit. They either quit or they keep doing the same thing over and over and over, and then they're in the same spot for years. There's people in this industry who are literally waking up every morning to trade, doing the exact same shit, chasing strategies for years, and they never get a payout. Some of them don't even pass evaluations when you can literally do that just by luck. And so here's what's happening to most traders right now. They find a strategy, they see it looks simple, it makes sense. It makes sense based off of the video from the guy that they just watched. So then you go and you demo trade it, you paper trade it, you back test for a couple hours. It looks good, looks simple, it's working, and then the moment you take it live, you start losing. It doesn't do the same as it was when you were doing demo and back testing. So then you think, oh, I probably just need to tweak it. So you go in, you tweak it, and then you lose again. So now you start wondering to yourself, does this strategy even work? Is this strategy even real? Did it stop working? Did the market change? And then they go back to YouTube and then they find another video with some guy saying that he has a 90% win rate or this one setup changed his life, like I was mentioning earlier. And it looks simple, looks clean again. So you try that one instead. You just keep going until you think you're going to find something that's going to work. And the problem is that logically, this cycle makes sense. Logically, when you're inside of it. Of course, you change strategies when the current one isn't working. That's rational, but it's based on a false assumption. The assumption is not that the strategy is the reason you're losing. And almost every time, for most people, it's not. Then the thing is like in most cases, if it's not the strategy, then what is it? Well, again, you do need an actual strategy that has an edge. You do need an actual edge. But the only way you can execute on that edge, again, is if you have the right foundation. So in my own experience, both from trading on my own and watching other traders just trade and seeing the people around me who are also trying to be a consistently profitable trader, it always comes down to three main things. Most traders don't actually have real risk management. They have the idea of risk management and they know they're supposed to, they know the rule where they hear it and they say, oh, you're only supposed to risk 1% of your account and they know they're not supposed to overtrade or oversize. And they know they're not supposed to add losing positions and blah, 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 blah. We hear this all the time. Everyone knows this. But then the market opens and then all of that shit just fucking flies out the window. Just flies out the window. It's like, imagine if you're training to be a fighter, okay? And you're in the gym, you're punching the bag, you're doing the pad work, you're sparring with somebody, and you have a plan. You've been watching tape on the other guy. You know how you should be fighting this guy. You step into the ring on the day of the fight, you get punched in the face, and then all of that planning just fucking flies out the window. Everybody has a plan. I know you guys have probably heard this. Everyone has a plan until they get punched in the face. And it's the same when it comes to trading. Real risk management isn't a rule that you follow when things are going well. Real risk management is what keeps you alive and keeps you in the game when things are not going well. And the entire point of it is not so that you make more money. It's so that you have an account to trade tomorrow. Because if you don't have an account, then what are we talking about? Strategy, setup, risk management, psychology. You don't have a fucking account. None of it matters anymore. None of it matters. None of it. Not your edge, not your skills on the chart, not your setup. None of it. So, survivability isn't boring. It's actually the most aggressive long-term strategy that you have. So your goal when you sit down to trade is not to make as much money as possible. Your goal is to lose as little money as possible, pretty much. That reframe alone changes everything about how you approach the market. Now again, I'm going to say this a few times because it's really important. You need an edge though. You need an edge. I'm not going to sit here and tell you that all strategies work and that it's all about psychology and do that whole guru bullshit. But look, if you're going to try and trade and you're trying to execute an edge that you've tested or whatever, the only way to execute that edge in live market environments is by executing it on a foundation that you've built. And so there's things that we do that are variables that go against our edge. Like for example, one of them is tilt. Here's something that a lot of people get wrong about tilt. You can be perfectly calm, but you can be tilted at the same time. A lot of people like to think about tilt meaning that you're angry or you're getting sweaty or hot, or you're trying to identify tilt through emotions, I guess. But you can sit there, you can be totally fine, but you can still be in a mental state where you can't evaluate a setup correctly. You can't make calculated decisions. And so people won't realize that they're tilting until they start feeling the feeling of tilt. And by that point, I mean, it's like, fuck, dude, you already lost. You already lost. Probably at that point, your account's basically gone. And some people don't even realize they're tilting until the account is actually gone. So how do you know that you tilted? Well, it's not necessarily based off of emotions. It's based off of behavior. You got to watch your behavior. It's not your feelings. Did you just take a trade that didn't fully meet your criteria? Did you just increase your size because you lost 3 in a row and you're trying to make it back quicker? Did you just hold past your stop because you think it's some type of liquidity grab and that it's going to come back? Those are all tilt behaviors, and you can be totally calm while you do all of that. And they're almost always invisible to the person that is doing it. And I've blown more accounts from tilt than anything else. Before I started trading, I used to just gamble all the time. I would go to the casino probably every weekend, knew I was going to lose money. I found it fun. I just loved to gamble. And then I started trading, and then I treated it the same way. And then I tilted constantly every day, blow 2-3 accounts every day. I'd hit my daily loss limit. I'd tell myself I was just going to take one more trade, see if I can make it just a little bit less of a loss. And that turned into another trade and another trade and another trade. And then next thing I know, my account's gone. Whip out the credit card, go get another account, do the same exact shit over again. And I thought I was being disciplined by sitting there and watching the charts and making sure I wasn't missing any opportunities and not getting distracted, but I was actually doing the opposite. The fix isn't necessarily having willpower. The fix is having hard rules set in place that stops the day before tilt ever sets, before tilt ever gives you the opportunity to even act on it. When you hit your daily loss limit, you close the platform. Not after one more trade, not after you sit there for another 20 minutes and see if a better opportunity pops up, not after you check the chart one more time. You close it. You just close it. And so there are things that people who are trading, who are struggling trading, don't realize is even happening. And the way that most traders approach this is you see somebody online, he makes a lot of money. You go, oh, that looked easy. I want to learn how to trade. You click on the guy's profile. Oh, in this guy's profile, he's got this one strategy or this one setup that changes his life. That he has this 90% win rate, whatever the fuck it says. I don't know. People say the same shit. But the point is just like you try and learn it and you try and make it work. And that's the first thing you do. You just try and make the strategy work. Then you realize, oh, I need risk management. And then so you start reading about psychology. You hear traders say you need to read trading in the zone and best loser wins and all these different things. So then you start focusing on that. And then eventually, after losing a lot of money, you start to understand that you should have started with the foundation. You should have started with the foundation, not the strategy. Strategy is not the foundation. The strategy is something you build on top of the foundation. But people do it backwards. And doing it backwards is going to cause you to lose thousands of dollars. Think about it like building a house, okay? If you know anything about building a house, you have to lay a foundation before you put up the walls. You don't put up the walls before you pour the foundation. You don't put the roof on before you build the walls. And it happens in a specific order because each layer depends on the one below it. You don't put up the walls on a shit foundation and then start to blame the walls for not staying upright. That's not how it works. And trading is identical to that. Foundation first. How does the market actually work? What am I trading? Like, what is this? How to manage risk. How to take losses correctly. Then the strategy. Then bankroll management and scaling. It's in that order, always. Always. The typical order is like people will come in, learn a strategy, try and scale it, then try and learn risk management and psychology, and then try and figure out what the market's actually doing. You're doing it backwards. If you jump to the strategy before you build a foundation, you are going to blow up. You are going to lose. You may get lucky, you may have some variance, you may have like a good month or whatever, but over time you're going to lose. And then you're going to blame the strategy. You're going to say, oh, well, that strategy doesn't work. And you're going to go to another strategy. And then it's going to happen again because the foundation was never there to begin with. So what do we actually need to do? Well, we need to start with the right goal. So the first shift is the hardest one because it feels counterintuitive. Stop trying to make money. You need to start trying to stay in the game. I know how that sounds. You're trading because you want to make money. We're all trading because we want to make money. I know. I get it. But here's the thing. For me, when I stopped focusing on trying to make money and started focusing purely on surviving, on not blowing accounts, not blowing 2, 3, 4 accounts every single day, not whipping out my credit card to then re-up on more accounts just to do the same shit again, that's when the money actually started coming. Every morning before you sit down, your only question really is, what's the most I'm willing to lose today? And when you hit that number, and it has to be a real number. See, here's the issue. People will be like, I'm going to stop trading after I lose $500. But they were never really willing to risk $500 in the first place. And so when you do hit that $500, it's uncomfortable. And you want to fix that uncomfort. So you're going to try and fix it. And that means you're going to try and continue to trade. So when you set a daily loss limit, you need to be honest about it. People set loss limits without really thinking about what it's going to be like when they actually hit that loss limit. So it's really important that you choose the right number for you. I can't tell you what it is. Somebody can be totally comfortable with losing $1,000 on the day. Somebody might not be comfortable losing a few $100s on the day. Now, if you're not willing to lose any money on the day, well, then guess what? You should probably go do something else because there's going to be days where we lose. We're not thinking about, oh, I'm sitting down at my computer. How much money am I going to try and make today? What's my profit target today? It's what is the maximum amount of damage that I can live with before I shut it down, before I stop. So that's the lens. That's the foundation of every good trading day. The traders that I have met in this space that I actually respect, the ones who are actually consistently profitable, they all have one thing in common. They care way more about how they traded than how much money they made. A losing trade that was executed correctly, like right entry criteria, proper sizing, properly placed stop, taken off at a structural invalidation area, that's a good trade. You did your job. The market just didn't cooperate at that time. A winning trade that came from a revenge trade, where you already broke all your rules and you're just trading out of desperation to make your money back, that's a bad trade. It doesn't matter if it wins or loses. That is a bad trade, even if it made money. It's a bad trade even if it made money, because you didn't trust your process. You gambled. You got lucky. And that's not going to consistently happen over a long period of time. That's a ticking time bomb. If you do that, that is a ticking time bomb. You're going to blow all of your accounts if you continuously do that. The process has to be defined before you ever touch a live account, before you ever get into a funded account, not after, and definitely not while you're figuring it out. Before. Has to be before. So if you're serious and you're struggling with trading, if you're serious about trying to be profitable and trying to actually change the results or the outcomes of your effort, here is the sequence. And I need you to trust this order because every step depends on the one before it. The first step in the proper foundation for learning how to trade is understanding how the market actually moves. Not pattern recognition, not when this candle pattern appears, you buy, or when this indicator prints a buy signal, you buy it, and this is where you place your stop and your TP. No. Understanding why price is actually moving. What is driving it? Why is it bouncing back and forth? Why is it running in a singular direction? And who's on the other side of the trade that you're taking? Because without this, you're essentially just guessing. The second step is risk management. And that includes like how to actually take a loss, because they're going to happen. How to take a loss, how to size into positions, how to define before the entry what it is that you're actually doing, and where it is where you're wrong. This is the foundation for everything. And if you skip this, the other steps are just going to fall apart. Step 3 is the strategy and the entries. Actually learning and validating what your edge is and how to execute on it. Again, perfect psychology with a bullshit edge is not going to work. It's just not going to work over a long period of time. You won't be successful unless you have an edge. There's no going around it. Anyone who sits here and makes these types of videos and tries to talk about psychology, at the end of the day, it is the strategy too. It is. You do need to have an edge. But the thing is just that this is where most traders start, and it's the wrong starting point. It's just the wrong way to start. It should be after the first 2 steps. And then the 4th step, if you're trading prop firms, is bankroll management, but specifically with prop firms. How to use payouts to fund evaluations, how to scale properly without ever going into the red, and how to build multiple income streams from multiple funded accounts. That's the order. Foundation, risk, edge, and then scaling. Most people try and do like edge first, scale second, risk third, and then 4th is the foundation. And they wonder why nothing works. And the last thing that I want to talk about in this video before we wrap it up is just the timeline. People get into trading because it looks like it's so easy. It looks like it's so easy, right? People get into trading and they expect to be profitable in like 3 months. And when they're not, they feel like they're failing. They see everything online. Everyone's always winning, right? That's the only thing we see online. Everyone's always winning. Why am I the only one that's losing? And then they say, trading is a scam. All these videos of these guys who are telling me strategies, they say it works for them. I tried it. It doesn't work for me. I'm losing every day. Trading this guy's same strategy and he's winning every day. This shit is a scam. Well, take some time to be good at trading. It takes some time. You know, they say, like, you hear the thing where they say it takes 2 to 3 years to be profitable in trading. And for some people, it might be faster, and for others, it might be longer. And it all has to do with the behaviors and the person that is actually attempting to trade, because everybody's different. There's going to be people who have behaviors and tendencies that they do in their normal day-to-day life that's going to translate well to trading. And then there's other people like myself who like to gamble, where that's a terrible thing to bring into trading, but you're going to bring it in because those are behaviors and patterns that you typically do outside of trading. So depending on the person, it can take a long time, or it can just start working for you because, again, everybody's different. But they say 2 to 3 years to be profitable. Now, do I believe that? I don't really know. Did it take me 2 years basically to become profitable? Yeah, so I guess I support that statistic. So that's one thing to consider. But that's just the reality of it. We'll just say 2 to 3 years. That means 2 to 3 years of losing money, of learning, adjusting, tweaking, and building the mental infrastructure to be able to successfully trade profitably, consistently, long term. And I'm not saying that necessarily to discourage you. I'm saying that because it's important to understand the timeline of this learning curve or this process going into it. I'm sure a lot of people who are watching this video are, I would assume, are probably in their first or second year of trading, or even their first couple months of trading, and they're not finding success. If you understand the timeline, you're going to make decisions that are going to keep you in the game long enough to get there, instead of blowing everything, trying to shortcut it, and then just saying, this shit doesn't fucking work, and then quitting. The people that lose everything, why? They try and shortcut the timeline. It takes time to learn how to trade properly. We're dealing with money, we're dealing with emotions, this is not easy. People size up too fast. They over leverage. They can't accept the fact that they're wrong. They don't like being wrong. They skip the foundation. And the people who make it, well, they understand that this is a long-term game, that this is a long game. And they decide that they actually want to play the long game. If you have the right process and you actually follow it, I genuinely think you can cut that 2 to 3 years down significantly. And that's not because trading gets easier, but it's because you stop wasting time on the things that don't actually matter. So on that note, I do want to talk a little bit about psychology when it comes to trading. Now, one of the biggest things that affected the way that I trade and helped me become more consistent is changing the perspective from trying to make money to focusing on the process of execution and the quality of that execution, as well as just the mindset of survivability. Because if you can't survive long enough for edge to actually compound, then nothing else actually matters. And most traders actually have it wrong. They are obsessed with the front end of their trading. Entries, setups, indicators, win rate, optimization, and they will spend years trying to perfect the front end without ever focusing on the back end of their process. But the back end is where accounts actually go to die, and it's where you actually have control over it. You don't necessarily have control over how many A-game setups the market might offer you in any given session. And when I started to understand this, I stopped focusing on grading performance based off of P&L alone. And I started grading myself off of something that I read in a book from Jared Tendler. It's called The Mental Game of Trading. It's an amazing book that talks about the psychology of trading. And I've read many psychology books in terms of trading and also just normal psychology books, but The Mental Game of Trading was the one that actually resonated with me the most. And it introduced this concept to me of A game, B game, and C game. And I've heard this before, but it was provided in a way where it actually made sense. Now, as most of us know, your A game is when you're fully aligned with your system. So you followed your process, you waited for conditions, you respected risk, and your execution was actually clean. And that does not mean that every A game session actually produces a green P&L, because you can trade perfectly and you can still lose. That's something that a lot of traders just struggle to accept, because in trading, a good trade can lose and a bad trade can actually win. Now, when it comes to B game, your B game is still acceptable. Maybe execution isn't perfect, maybe you hesitated a little, or maybe you forced a trade, but overall, you stayed structurally sound. But the C game trading, or the back end, is where the destruction actually happens, and it's what we actually have the most control over. C game is emotional trading. That's things like revenge trading, or oversizing, or forcing trades in chop, or ignoring invalidation, and breaking loss limits trying to make money back immediately. And here's the dangerous part. This is the exact reason why most traders blow up and destroy accounts. 1 or 2 C game sessions can destroy weeks or even months of A game or B game sessions. Now, the important thing to understand in trading is that there are necessary losses and there are unnecessary losses. Necessary losses are just the cost of doing business. They're business expenses. You followed your framework, the environment was valid, the setup that you chose to take met the proper criteria, and you actually executed on it correctly, and the trade lost. That is normal. That is variance. That is the cost of participating in a probabilistic environment. Unnecessary losses are totally different. Those are losses that are created by emotional decision making, taking trades during low volatility chop, or trading without a plan, or moving stops emotionally, or revenge trading after a loser, or even after a break even, or just simply trying to force the market to pay you today. Necessary losses are unavoidable, but unnecessary losses are where traders destroy themselves. And most traders spend all of their time and energy trying to eliminate necessary losses instead of trying to eliminate the unnecessary losses. And that's backwards. It's backwards. One of the most important concepts that I've ever understood in trading is the process of tightening the back end. Tightening the C game, reducing the C game. Most traders only focus on improving performance when they're at their best. They optimize setups, they optimize entries, they optimize their different confirmations. But that's front-end optimization. And tons of struggling traders just do not study themselves when they're emotionally compromised. They actually don't even want to think about it, and they just cope and they say, oh, well, I'm just going to follow my rules next time. But they're not truly analyzing what happens after a loss. They're not studying the tilt patterns that they have for themselves, and they're not identifying those trigger points. And more importantly, they're not building a system that activates when judgment degrades. I mean, we all know that when you start tilting, it is incredibly difficult to stop, and usually it only stops in one of 2 ways. Either you blow the account or you end green on the day. Neither of those are a good outcome. But traders ignore this, and then they repeat the same cycle over and over and over. So then what is back-end tightening? Well, back-end tightening means building structural defenses against your worst behavior, against the worst version of yourself. Not motivational quotes, not, oh, I'm just going to try and follow my rules next time, or I'm going to try harder. It's not about relying on discipline in the moment. It's actual systems. It's hard shutdown rules, daily loss limits, trade limits, reducing size after emotional escalation, or just having the self-control to actually walk away when you start to recognize that your decision quality is degrading drastically. Because the goal at the end of the day is not necessarily to become a robot. The goal is to stop catastrophic sessions before they actually begin to spiral out of control. And this is also why traders fail once they actually start making money. The first payout is dangerous. Because psychologically, what happens a lot of the time is traders stop protecting capital and they start trying to accelerate outcomes. They increase size too quickly, or they increase accounts too quickly, and they end up increasing pressure too quickly. And then one emotional session wipes out everything that they've built. Scaling should happen after survivability has been proven. Most traders are so quick to try and scale, and it becomes a ticking time bomb for themselves. You do not scale before that happens. Think about it like this. A trader who cannot consistently protect a small account is not magically going to protect 10 of them, because more size or more accounts amplifies emotional instability. It does not fix it. And this is why I always say you need to earn the right to scale. First, you prove consistency, then you prove emotional control. Then you prove that you can actually survive variance for your edge. And then you can actually scale, but you scale systematically, not recklessly. Because in trading, longevity matters more than speed. The real goal in trading is to think in terms of long-term consistent success or long-term success. It's not necessarily about making money today or making money on this trade or this session. It's about being able to trade tomorrow, being able to continue to trade. And that line completely changed how I viewed trading. I talked to so many traders and they all claim they have the same problem. Oh, I just can't follow my rules, or psychology, or blah, 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 blah. You cannot treat every session like it's a life or death situation. And if it is a life or death situation, you're doing something wrong. Once you actually understand that, you stop forcing outcomes. You stop trying to recover losses emotionally, and you stop needing or itching for action every moment of the day. And you start thinking like someone who is looking to build long-term consistency instead of chasing short-term dopamine. Because a lot of traders think that consistency comes from being perfect. It doesn't. Consistency emerges when catastrophic behavior is removed. Because the traders who survive are not the traders that never lose. They are the traders whose worst days are controlled. And that's the game. Protect capital, protect decision quality, and protect your survivability. Because the whole point is, if you can stay in the game long enough and you actually have an edge, a true edge, you really do need an edge. If you actually have an edge, then the math actually has a chance to work. But again, you do need an edge. Anyone who sits here and tells you it's all about psychology is full of it. It's not how this works. You need an edge, you need a system, you need a strategy, and you need to trade it and execute it properly. It's not only about psychology, but at the end of the day, an edge or strategy doesn't matter if you can't execute properly. It literally doesn't mean anything. And I mentioned that earlier. So if you're serious about actually trading this and you don't want to spend another year stuck in the payout destroy cycle, I've got a few spots left in my one-on-one mentorship where I do live trading sessions, personal daily trade reviews, and direct message or access to me on a daily basis in the full framework of how I actually trade. But it's built out around your specific situation or problems that you may be facing and a lot of other stuff. So it's not some 600 person mentorship where you're not actually getting the attention or the help that you really need. And if you follow the process and you do what I say, and within 90 days, if you're not able to pull a payout, I keep working with you for free, doesn't matter how long, until you can actually pull one out. So the risk is on me. And that's how confident I am in this program. So if you're ready, fill out the application. It's the first link in the description below. And if you're not ready, no stress. I post content on my channel for free that you can watch and you can hopefully find some educational value from. I'll catch you guys later. Peace.